are formed, whether they are subsidiaries or associates. And we said that when one company is said to be a parent when they own more than 50% of the shares.
Which of the shares? We have so many types of shares.
Of the shares? Equity shares.
Equity shares, okay.
Yes, of another company. And we said
Eva, your this thing, okay.
okay, and we said that if another company also owns 20%, they are termed to be associates.
Okay.
And we also talked about the purchase considerations.
Okay.
Please, is it okay? Should I say more?
Go on. Yeah,
Okay. And we said there are various forms of purchase consideration. We have the cash, we have the deferred consideration, we have the share exchange, and we have the contingent consideration. Yes. And we said the cash, that is when, let's say, company A acquires company B using cash, paying in cash.
Okay.
And with the deferred consideration, that is where company A acquires a part of company B, but pays it at a later date. That is, the payment is deferred to a later date, like 2 years or 3 years time. And we said, sorry about that, my kids. And we said with the, hey, go back. And we said with the contingent consideration, that one is dependent on a set target. That is, that the payment will be made once a target has been achieved or something that was put up has been achieved.
Okay.
I think it's okay. Somebody should say something.
Okay. Habakkuk, apart from whatever said, what did we do again? Habakkuk, what did we say again? What did we do apart from what? Zoom user, Habakkuk, I know that you are the Zoom user. So, who was here the last time? Kafi, were we here the last time?
No, please. That's my first time joining.
Okay. But have you heard about group account before? Consolidated financial statements.
Yes.
What did you know about it?
Okay, so I tried watching the video, but at a point I went off because of my bad network. So I realized that we have different types of consolidation, where you mentioned if you have more than 50% of the subsidiaries shares, you are the parent company.
Okay.
And you have less than 50 to about 20%, you are an associate.
Okay.
Then less than 20%, you said it means the person is just investing into the company to earn some equity.
So which standard are we going to use for that? I mentioned the standard too.
Okay, then I didn't get the standard.
Yeah, I said that you are going to account for that as a financial asset using financial instruments, IFRS 9.
Okay.
Okay, that is very nice. We also look at when do we say this particular company has a control over another company. And we also say, when do we say there is a power? When do we say there is a power? Those are also some of the areas that they can examine you on. Consolidation is 25 marks. Calculation will take 20 marks and theory will take 5 marks. So the theory, they are going to base the theory on this one. They can ask you to explain the various forms of consideration that we have. That is for 5 marks. They can also ask you, when do we say there is a associate relationship? We look at that the last time when the investor has a participation in on the board of the investee, when it takes part in the decision-making policy or those kind of things, when there's a material relationship between them, when there is exchange of management or something like that, when the investor provides a technical assistance to the investee, you have to look at those ones. They have examined that one twice. For the associate relationship, they have examined that one twice. It came in May 2021 and also April 2022. So I'm sure they have examined when do we say we have power. That one too, they have examined that one maybe November 2021, only once. When do we say we have control? That one too, they have examined that one. But they are yet to examine the types of the consideration that we have. So in as much as you are waiting for the calculation, you should be reading the theory too, because 5 questions will come from consolidated financial statement, which will be purely theory. So if you are learning the calculation, be learning the theory too. But there is no way you can know the theory when you don't know the calculation. That is also another factor. So today, we have spoken about the theory aspect of the consolidated financial statement last week. So if you don't have access to that video, you can go to the Telegram page and make yourself comfortable with that particular video. Today, we are going to look at what we call intra-group transactions. You see, last time I was saying that for you to understand the principles of group accounts, you have to see one company as a headquarters, and you also have to see another company as the branch. So if you have more than 50%, we say we have subsidiary parent relationship or parent subsidiary relationship. When this form of relationship exists, what you are going to do is that take the parent as a head office and take the subsidiary as a branch. What do I mean by saying that? If you are the owner or you are part of the owners of MTN, now you want to expand to Togo, you don't have more. We have so many ways of expanding. We can be internal expansion or external, which is through acquisition or merger. But this one, we are assuming that it's only in acquisition. It's only in acquisition. So what we do is that, okay, there's also some form of transactions that will not lead to acquisition, or there is some form of business transactions that will make it difficult for you to identify who is a parent and who is a subsidiary. Before I will talk about the intra-group transactions, let's move on to that. That one nearly escaped me. So sometimes, you see, if the parent is buying, if one company is buying the other company, that one you can easily identify this person is the parent, this person is the associate, this person is the subsidiary, and those things. But there's some form of transactions which will be very difficult for you to identify who is the parent, who is the subsidiary, and who is also the associate. Okay, so do you agree that there are some form of business transactions that will make it difficult for you to identify who is the parent, who is the subsidiary, and who is the associate? Do you think that there will be some form of business transactions that will give you a situation like that? Philip, do you think there's some form of business combinations that will make it difficult for you to identify this person is the parent, this person is the subsidiary?
Yes, sir.
Okay, what are those? Give me one example of those business combinations, those form of business combinations that will make it difficult for you to identify this person is a parent or this person is a subsidiary.
So this one, yeah, unless you help me.
But you know that there's some form of business transactions like that. If you know, then you should know one of them. Evan, do you agree with him? Eva, do you agree with us that there's a form of business combinations that will make it difficult for you to identify who is?
No, I don't. I've not heard of for that. For us to call someone a parent or a subsidiary, one should have a greater share than the other. So please, I have not heard of that one before.
Okay, Claudia. Claudia, do you have any idea? I want us to move fast. Like, can someone help us? Okay, you see the kind of consolidation that we are doing over here, or what we are going to do, is purely based on the assumption that the parent is acquiring the subsidiary. The parent is acquiring the subsidiary, which is acquisition method. So we are assuming that we are using acquisition method where you can clearly identify that this person is the parent and this person is the subsidiary. But we also have some form of business combinations which will make it difficult for you to know who is the parent and who is the subsidiary. One of those is takeover. When there is a takeover, who are you going to call the parent and who are you going to call the subsidiary? Now you have a company, or let's look at these banks. Look at these banks that GCB has taken over some of them. Who are you going to see as a subsidiary and who are you going to see? Okay. Komina, I didn't get your message first. All right, let's move on. So when there is a takeover, GCB has taken over some of the banks over the years. Yes, because GCB is going to prepare financial statement for the two accounts and say a group. But in this case, we can't say GCB is a parent and GCB or the other banks are subsidiary, because GCB hasn't acquired the banks. So when there's a takeover, it is very difficult for you to identify who is the parent, who is the subsidiary. And also, if you have merger, if there's a merger, it is also difficult for you to know who is the parent and who is the subsidiary. Looking at Airtel Tigo, their issue, can you say Airtel is the parent and Tigo is the subsidiary? Can you say that? Airtel Tigo. Ava, can you say that?
So what are the percentages?
The percentages doesn't do anything. We only identify parent and subsidiary when you are paying for the shares. Airtel Tigo is neither paying for the shares. Airtel is neither paying for the shares of Tigo, and Tigo is neither paying for the shares of Airtel. So there's nothing like Airtel is having control over Tigo or Tigo is having control over the one. No. So irrespective of the shares, still there is nothing like parent-subsidiary relationship. Niyama, are you okay?
Yes, boss.
Okay. So if there is a merger, it is very difficult for you to identify who is the parent, who is the subsidiary. When there is also a takeover, you can also determine that. When there is also a transfer of ownership, maybe you have a company and your mom also has a company somewhere. Now she wants to transfer that particular company to you. Now you can't say you are the parent of that company. Your mom's company is a subsidiary. You can't say that. So I don't know whether they are going to ask you this in the exam, but if they ask you about what are some of business, what are some of transactions that will make it difficult for you to identify a parent-subsidiary relationship or subsidiary-parent relationship, these are some of them. Merger, takeover, transfer of ownership. You can think about any of them, but these are the three that I can give to you as I'm talking today. Are we okay? Eva, are you okay now?
Yes, please.
Do you have any question before we move on?
You were talking about Eto to go, and I
Yes.
wanted to ask, can you term those as a joint venture or joint operation?
Yes, joint venture too is also, yes, that is also another example. A joint venture is also a situation where it will be very difficult for you to identify parent-subsidiary relationship. That is very nice. That is very nice. All right. All right. Can we move on? All right. So today we are going to talk about intra-group transactions. If we are saying intra-group transactions, we are saying that business transactions happening within the group. Business transaction happening within the group. So we are saying that owners of MTN want to expand to Togo. So what they will do is, as they don't have the money to go and establish themselves there, they don't have the money to go and put the infrastructure, those things needed over there. They don't have the money. So what they are going to do is that they will just identify a company which is already in the telecommunication industry of Togo, and they will go and acquire, or they will go and buy that particular company. So if they are buying that particular company, it means that MTN is now in Togo through that particular company that they have acquired. So what will happen? If MTN wants to have access to Togo customers, MTN will not go there and go and sell. MTN will just transfer some of the SIM cards or some of the merchant SIMs to that particular company over there. And that particular company will sell it to the customers in Togo. Or MTN can decide to go and buy Togo. So one of the networking company or one of the telecommunication company in Togo is Togocell. We also have Move. So MTN can decide to go and buy one of them. So MTN will be selling to Togolese through the Move or this one. So what happened is that MTN is just transferring these SIM cards to another branch, which is the Togocell. The Togocell now becomes a branch, becomes part of MTN. So MTN is just saying that, okay, since you are there already, let's just transfer these goods to you so that you sell it for us. You sell it for us. It's just like you have iPhones, you have phones that you are selling, and you have a friend. You just say, okay, you ask your friend to sell the phones for you. Your friend is not buying the phone from you and reselling it. You are just giving it to him that he should sell. So whatever happened is that if you give the phone to your friend that he should sell it for 20 cedis, the 20 cedi is the price at which your friend is going to sell it. So your friend is not going to make profits. He's not going to make loss. So the selling price, which is the 20 cedis, becomes the cost price for your friend. And at the same time, the selling price for your friend. The best that you can do for your friend is to give him a commission. So we are going to look at if that happened within the group. If MTN transfer SIM cards to Togocell in Togo, what happens? If all the SIM cards have been sold by Togocell, then we say that, okay, all the SIM cards has been sold. So MTN can now realize the profit that they want to realize on that particular SIM cards that they have transferred to Togocell. But what if Togocell was not able to sell all the SIM cards? Then that portion of the profits that MTN has already entered in its own books will not be realized. That's what we are talking about. So when you transfer goods to your branch, you have a headquarters in Accra, branch in Kumasi. The only thing that you are going to do is that you just transfer the goods. If you are selling electrical gadget, you transfer the electrical gadget to the branch in Kumasi. This one, the branch is not buying from you, but you are just sending the goods to the branch so that you can sell it to the customers in Kumasi. If you are telling the branch manager in Kumasi that, okay, sell one bulb at 5 cedis, the branch manager will not go and add 1 cedi to it and sell it 6 cedis. No, he or she will sell it 5 cedis. So if you are saying 5 cedis, it means that is a selling price for the headquarters in Accra. So they will just sell it 5 cedis and send all the money, all the proceeds to you. But what if they did not sell all the goods? It means that the profit that you are thinking that you are going to get from the sale of all of those ones, you are not going to get that particular profit on those quantities that were not sold. But in your individual financial statement, you are going to recognize all the sales and all the cost of sales and assume that you are selling to the branch in Kumasi. The branch in Kumasi will also receive the goods and also account for it in the individual statement. But if you are now preparing a branch or a group account, which is for the headquarters and the head office, you are just selling one commodity. It is only one bob that is moving. So the sale of the branch now becomes the sale of the group. The sale of the branch now becomes the sale of the group. We are going to pick an illustration and I will demonstrate what I'm saying. Okay, can you see my Excel sheets? The plain one. Can you see the plain one? Can you see the Excel sheet that nothing is written on it?
Yes, we can.
Okay. So we are saying that the parent is A or the head office is A. The branch is B. Okay. So they are now transferring 100 bags of cement at 100 bags of cement at 100 cedis each. At 100 cedis each. So what will be the total? What will be the total selling price for the 100 bags of cement? What is be the total? What will be the total selling price for the 100 bags of cement?
10,000.
It's 10,000. Okay. But what happened is that the cost price of one of the cements is we bought it, the 100 bags of cement, we bought them at 80 cedis each. So what will be the cost price now? What will be the cost price? We bought them is 100, not 1,000. 100 at 80 cedis each. What will be the cost price?
8,000.
8,000. Okay. So you are now the head office. So what you are going to do is that you just transfer the goods to the branch. If you transfer the goods to the branch, what are the entries that you are going to do? What are the entries that you are going to do? Goods transfer to branch. What are the double entry? What are the entries that you are going to pass? Oh, what we are doing financial reporting. A double entry should not be a problem for us. What is a double entry?
You debit your inventory.
How?
You said you are transferring goods, or?
Yes, I'm transferring goods to the branch B.
You debit cash, you credit inventory.
No.
No.
If I'm transferring at cash, let's assume that is credit. We are not taking anything from them yet.
So you debit your inventory and then you credit your debtors account.
No. If you are selling to a customer, what is the double entry?
You debit the customer.
Okay.
And then you credit yourself.
That is it. So you debit the branch, which is the Kumasi branch, which is now a debtor, because we assume that you are transferring the goods to them on credit. Then you credit your sales accounts or the revenue accounts.
Please, which one is the A and which one is the B? I don't know. I'm lost.
The A is the headquarters, B is the branch.
Okay. So the headquarters is the one transferring the goods to the branch.
Yes.
Okay. And then the 100 bags at 100 cedis each.
Yes.
And then the 100 bags at 80 cedis each. Oh,
The-
please, what does it mean?
They are transferring at 100 cities, but they bought the items at 80 cities.
Okay. Okay. Okay.
All
Thank
right.
you.
So let's not we should not bother ourselves about the double entry. I know that a lot of problem will come. Okay. If you come to profit or loss accounts, okay, if you come to profit or loss account for A, profit or loss account for A, how will A account for this? A was assuming that they have sold all the 100 bags to B, isn't it?
Yes, please.
So they are going to have revenue or sales of this one. And that will give us 10,000, isn't it?
Mm,
And then what are they going to do again? You have cost of sales, isn't it?
80,000.
Cost of sales. Cost of sales as what?
8,000.
8,000. Then they assume that they are having a profit of what?
2,000.
2,000. Okay. Okay. This, you see, this 2,000 of profit will only be appropriate if you are selling to a third party. If you are selling to a third party. But in this case, are you selling? Are you selling at all? Are you selling to B at all?
You are transferring.
Are you selling to B? Is A selling to B?
No.
A is selling to third party. A is selling to B to a third party, isn't it?
Mm-hmm.
Okay.
Yes.
So A has just given the goods to B that, okay, sell these goods for me. So at the end of the day, the figure that B will come and say, oh, this is the quantity of the goods that are sold. This is that will be the sales for A, isn't it?
Mm-hmm.
Okay.
Mm-hmm.
Okay, let's move on. So B in the statement of profit or loss for B, what is going to happen? Profit or loss for B. Let's assume that B sold all the goods. So what will be the revenue for B?
10,000.
10,000.
10,000. What will be the cost of sales?
8,000.
10,000.
Cannot be 8,000.
10,000.
It will be
Thousand.
B is not going to make any profit on the sale. You are selling that thing on behalf of
Yeah.
someone. You will not make any profit. So at the end of the day, since all the goods were sold, B will now send 10,000 to what? A. And now A will say that, okay, I have sold all the goods, so I can now realize the profit of 2,000, isn't it?
Okay.
Yeah.
But in most cases, what happened is that B will not be able to sell all the goods. So let's assume that B was able to sell only 8,000. So if B was able to sell only 8,000, it means that B was able to sell only 80 bags of cement, isn't it?
Yes.
So if B was, so this will still be what? 8,000 again. The cost will still be the revenue for B. But what will happen to A's accounts? Will A be recognizing a revenue of 10,000?
No.
What are they going to recognize?
8,000.
What will be the cost price?
80 Ghana. 8,000.
No, the cost price. They have sold only 80 bags. So 80 times 100 is 8,000.
Yes.
So we are going to calculate the cost price for only 80 bags too. So one bag is 80 cedis.
Okay.
Okay. So what will happen?
8,000.
Now what will be the cost of sales? 80 times 80 is what?
64. 64.
6,400.
6,400. You can't use 80,000. 80,000 is for all the goods. Now you have sold only 80. So you have to calculate for the only 80, which is 80 times 80. So what will be the actual profits now?
1,006.
1,006. Okay.
6.
Let's come here. What is the profit per bag?
It's 2.
Is 2, isn't it?
Yes.
Profit per bag is 20.
20.
180 is 20, isn't it?
Yes.
Yes.
Okay, so if you have sold 80 bags, what will be the total profit?
1,006.
1,006. Okay.
1,006.
That is how we got 1,006, isn't it?
Yes.
All right. So in actual sense, what A will do is that 2,000 of the goods were not sold, isn't it?
Mhm.
Because 20 of the
Yes,
goods were
yes.
not sold. So A will come and subtract 2,000 over here. Okay. If 2,000 of the goods were not sold, what is the cost price of those 20 bags that were not sold? What is the cost price of those 20 bags that were not sold? What is the cost of those 20 bags?
2,000 times 80.
20 times 80 or 2,000?
Yes.
1,600.
1,600 were not sold, isn't it? So if you do
Yes.
this, you are going to get a profit of what? 1,006. Are we there?
Yes.
If you do this, you are going to get a profit of 1,006. But do you know what we normally do?
If you do which one, please?
Go and brush your teeth.
In the books of A, we are having revenue of
That's it, well, okay.
10,000, isn't it? But at the end of the day, they realized that only 8,000 of the goods were sold. So we have to reduce the 10,000 to 8,000.
And I need to go with you.
Eva, are you there?
Yes, please.
Okay, we have to reduce
Yes, please, I'm here.
we have to reduce the 10,000 to what? 8,000. Eva, can I move on? Someone is saying that if you should do what? So I want to move on.
Yeah, I'm the one who said it. It's not.
So you can reduce it to, you are coming to reduce it to 8,000, isn't it?
Yes, please.
They have 10,000, so you just come and subtract the portion of the goods that were not sold, which is 2,000. Okay, the 8,000 that you have taken, which is the cost of sales, is for all the 100 bags. Now, you are not able to sell 20 bags. So you have to come and take the cost price that is relating to the 20 bags from the 8,000, because the 8,000 is for all the 100. So for you to get that cost price for the 20 bags is the cost price per bag times the number of bags that were not sold, which is 20 times 80. You have what? 1,006. So in actual sense, you will now be having a revenue of 8,000 and cost of sales of 6,400, which will now be what? 1,006. So if you calculate it, you see that you get a revenue of 1,006. That is what's supposed to be. But what we normally do is that, look at this. 2,000 and 1,006. What is the difference?
400.
400. Okay. So if that is the case, let's save ourselves the stress of what? Subtracting these 2,000 from this one. Okay, as opposed to subtract 2,000 here and as opposed to subtract 1,006 over here, isn't it? Okay, so if that is the case, what I'll do is that since I'll subtract 1,006 from this one, let me just add 400 to it, so that the 2,000 I'll subtract here and then the 1,006 I'll subtract here. Since I've added 200 to it, it's now 2,000 against 2,000. It will just go off. Are we there? At the end of the day, what profit am I going to have? 1,006, isn't it? All right. The 400 over here, the 400 that I have added, the 400 that I have added, this is how I got the 400. How many bags were not sold?
20.
What is the profit on each bag?
20.
No, 20
20.
cedis.
So what will be the profit that I will not be taking as a result of the goods that the bags are hiding sell?
20 by 20.
Which is what?
400.
400. So what we normally do is that just come and add the unrealized profit to the cost of sales, because you should have subtract 2,000 here, subtract 1,006 over here. But I don't want to do that. So what I'll do is that what figure will I add to 1,006 to make 2,000, so that if I do it like that, it will be 2,000 against 2,000 over here, which will give me 0. So I'll just come and add the unrealized profit. So what we normally do is that at the end of the day, the sale of the subsidiary, if it is a subsidiary that is selling to the parent, the sale of the subsidiary, okay, let me take it again. If it is the subsidiary that is selling to the parent, it means that the subsidiary will be the one that will be recognizing all the sales as revenue, isn't it? So at the end of the year, if you're preparing consolidated financial statement, the actual sale of the subsidiary becomes the sales for the group. because the subsidiary cannot sell to a headquarters. No, branch cannot sell to headquarters. They are just, you cannot sell to yourself. That is the issue. The branch is part of the headquarters, and you are now selling that you are selling to yourself. The branch is being owned by the headquarters. So how can you sell to yourself? It doesn't make sense. You can't sell to yourself. So if you're preparing consolidated financial statements, if the parent is the one selling to the subsidiary, the parent is going to have the unrealized profit. But if the subsidiary was able to sell all the goods, we don't have any issue of unrealized profit because you have sold all the goods. It means that the 10,000 that I have recognized is the sell. But if the subsidiary is not able to sell all the goods, the sale for the subsidiary becomes the actual sales for the group. Becomes the actual sales for the group. So what you have to do is that you have to calculate the profit on unrealized profit, which they always give you a percentage. We are going to look at that. Then you just come and add the unrealized profit on unrealized profit to the cost of sales. The assumption is that instead of you to go and subtract the portion that we are not sold from this revenue and come and subtract the cost, to just add the profit to the cost, then you just have the total. At the end of the day, to have, okay. Ato, which of the statement, the one that I just said, if it is a parent that is selling to the subsidiary, or which one? Or you cannot sell to yourself, which of them? Atu, which of them? Both, okay. We are saying that if you have a branch, your head office, if you have branch somewhere, the branch is part of you, isn't it? Eva, the branch is part of you, isn't it?
Yes, please.
Okay, so if you are transferring goods to the branch, will you say you are selling to the branch?
No.
You can't sell to yourself, so it doesn't make sense. But in the individual books, they are going to treat these ones as sales and as revenue. So if you are preparing your individual financial statement, the headquarters will be seen like they are transferring the goods or they are selling to the branch. The branch will also assume that they are buying from the what? The headquarters. But if you're preparing a group account, you're preparing the account for the whole company, you can't sell to yourself. So the actual sales for the branch now becomes the actual sales for the group. So if you're having a parent-subsidiary relationship, if the parent is the one selling to the subsidiary, if you're preparing a consolidated financial statement, the actual sales for the subsidiary becomes the actual sales for the group. Therefore, if the subsidiary is able to sell all the goods, then that becomes the actual sales. There's no issue about some part of the goods were not sold and this, so you're not going to have any issue. But if part of the goods were not sold, it means that the parent has recognized part of the profit in its individual financial statement, which is not what earned, because the subsidiary was not able to sell all the goods. So what we normally do is that instead of you to go and be subtracting like the way we did, no, don't do that. Just find a portion of the profit that is not realized, add it to the cost of sales like the way I have added the 400. Then you are good to go. You are good to go. After that one, what happens? After that, what happens? After that, what happens? Okay. We are saying that the subsidiary will be having what? 2,000 of the goods left, isn't it? Eva, subsidiary will be having 2,000 of the goods left, isn't it?
Yes, please.
Where would the subsidiary send these goods to? Where would the subsidiary send these goods to?
Inventory.
They will send it to inventory. But that inventory is the same as the inventory for the whole group, isn't it?
Yes, please.
But they are carrying this inventory at what selling price?
Yes, please.
But what should have been the actual price for the inventory?
The 80,000, 80 cedis.
It should have been 80 times 80, isn't it?
Yes.
Which would be 1,006. It should have been 1,006. So what is happening? The subsidiary is carrying the inventory at a higher price than what the cost. But IS2 says that inventory should be measured at lower of cost and its net worth.
Realizable value.
But if you look at the net realizable value, what are we having? It's 2,000, isn't it? And the cost is what? 1,006. So what are we going to do? What are we going to do? We take the 1,006. So what will happen to the inventory in the statement of financial position?
It is also more by 400.
So what are we going to do?
We deduct it from it.
So we go and subtract the inventory. So anytime that you have a sale within the group at a profit, If it is the parent that is selling to the subsidiary, then the unrealized profit will be in the individual financial statement of the what? The parents. But if it is the subsidiary that is selling the goods to the parents, then the unrealized profit will be affecting the what?
The parents.
Subsidiary. It is the subsidiary that is selling to the parents. So the unrealized
Okay.
profit will be in the books of the what? The subsidiary. But in any of these cases, the treatment is still the same. Calculate your portion of the unrealized profits, add it to cost of sales if you are doing statement of profit or loss accounts. If you are not doing that, then you take it to the what? Where you can find profits for the two companies. Where can we find profits? Where is profit found? If you're not doing the statement of profit or loss account, where can we find
Retained earnings.
we find a profit in retained earnings, because at the end of the year, profit for the year will be added to the retained earnings, which is the income surplus. So you go to the retained earnings of the subsidiary, then you go and subtract the unrealized profit from there, because the unrealized profit is part of the profit for the year for the subsidiary. If it is the parent, then you take it to the group retained earnings, which we call the retained earnings of the parent. Then you go and subtract it there. Whoever is selling, you still subtract the unrealized profit from the inventory in the statement of financial position. This is about when goods are sold at profits. When goods are sold at profits. So those of you that you go and just say you are looking for unrealized profit, you are going to subtract it from cost of sales, or you are going to add it to cost of sales. This is the assumption. This is the assumption behind it. You can't sell to yourself. Therefore, whatever you have given to your friend, the amount of the goods that your friend sold becomes the actual sales from you. Your friend will return the remaining goods to you and give you the amount that he has sold. That is simply the meaning of it. Okay, this is at profit. Let's assume that the goods are being sold at loss. The goods are being transferred at loss. The goods are being transferred at loss. The goods are being transferred at loss. Okay. Okay, let me do this. If you're preparing the account for the group, let's assume that we are preparing the account for the group. Okay, let's come to group or branch accounts. Let's come here. Profit or loss accounts. If you're preparing from the group, okay, revenue, what will happen? If you're preparing the group, that means we add the two accounts. So the parent will be having a revenue of what? 10,000, isn't it? The parent will be having a revenue of 10,000, isn't it?
Yes.
And the branch will be having a revenue of how much?
10,000.
8,000. Okay. Let's count to cost of sales. The parent will be having cost of sales of how much? 8,000. And the subsidiary will also be having what?
6,400.
No, it will be 8,000. The selling price of the goods is the same as the cost price for the one that is receiving the goods. You're not making any profit. All right. So let's come here. What will be the total revenue?
16,000. 18,000.
18,000. What will be the total cost of sales?
16,000.
What is the total profit?
2,000.
So this is the assumption that all the goods have been sold. So the parent can only make 2,000 profit when all the goods are being sold, isn't it?
Please, can you go over the first one, the revenue?
Okay, the revenue, what we do is that we take the revenue of the headquarters, because we are preparing for the two group. So the revenue for the first group and the revenue for the second one, then we add it because we are doing it for the
Wait,
whole company.
I'm coming, please. The 8,000. You said we transferred the goods, all the 100 to the branch. Am I right?
Okay, the assumption is that they have sold all the goods, isn't it? Okay, so let me put 10,000 here and 10,000 here. Okay, let's move on. All right. So the assumption that they have sold all the goods. So okay, let's go on. So this will also be 10,000, isn't it?
Yeah. Yes.
Okay, the cost of sales for the subsidiary will be how much? Will also be 10,000.
8,000.
Also be 10,000, right? Because
Okay.
the cost, you are just transferring the goods to them that they should sell it for you. Okay. So at the end of the day, this will be 20,000.
Mm-hmm.
And this will be what?
18,000.
So at the end of the day, you are still making a profit of what?
2,000.
This is the assumption that all the goods have been sold, isn't it?
Yes, please.
Okay. Let's assume that 8,000 of the goods were sold. 8,000. 8,000. So how would the
We
group?
do it in the cell
Okay.
E or
So this will now be 8,000, isn't it? That will be 8,000. Okay. And this will also be what? The cost of sales for the subsidiary will also be
8,000, 8,000.
okay. It will be 8,000 plus 8,000. So this will now be 18,000. And this will now be what? 16,000. The profit is still what?
2,000.
But is 2,000 the profit?
No,
What is the profit now? What should have been a profit? 1,006, isn't it? So the easiest way to do this is that, okay, what portion of the goods that were not sold? It was what? 2,000. Then you come and subtract the 2,000 from the parent figure because the parent is having the 2,000, the 10,000. Then what is the cost of the goods that were not sold? Because the parent is having all the costs relating to the 100 bags is 1,006. Then you subtract the 1,006 from it. Now at the end of the day,
Excuse me.
okay,
You said that the 2,000,
okay,
that was the portion of the goods that were not sold with
Okay.
the subsidiary. Am I right?
yes,
And then the cost of the sales that were not sold, is it with the subsidiary or with the parent?
with the parents, the cost of the goods that were not sold is in the, because the 8,000 is for all the 100 bags. So the parent is taking the 8,000. 100,000 is 10,000 is all for all the bags. The parent is assuming that all the goods have been sold, which is not the case. So what you have to come and do is that, okay, right now, since the goods sold is 8,000, the parent must also recognize what? 8,000. That is why we are subtracting the 2,000 from the
I'm
revenue.
okay with that. I'm
Yeah.
okay with that one.
Okay.
The cost of sales, when you come to the cost of sales, do you look at the cost of goods that were not sold?
Yes,
with
the cost
parent
relating to the
or
goods
with
that were not sold.
the subsidiary?
Is the same.
Because-
Okay, come again.
Because when you come to the cost of sales, the 8,000, the first 8,000, the cost of sales of the goods to the parent.
Okay.
The second one is the cost of sales of the goods to the subsidiary.
Okay. Okay. So in this case, the cost of sales is the same as the selling price for the subsidiary. So 8,000, it will cancel. So we don't have any issue to do with the 8,000, but we are looking at the cost of sales relating to that portion that is included in the person selling, which is not the parent in this case.
Okay.
So if you look at this one, 8,000 revenue, 8,000 for the subsidiary, you can see that 8,000 minus 8,000 is 0. So the profit is now based on 10,000 and 8,000 because this minus this is 0. So the profit is still based on the parents' items. So 2,000 were not sold. Come and subtract it from this place. 1,006 relate to the goods that were not sold. The parent is carrying 8,000. So come and subtract this one from the parents. So at the end of the day, we'll be having 16,000 against how much?
1,006.
No, 8,000 plus 8,000 minus 1,006. Is it 14,400?
Yes, 14,400.
So what is now the profit?
1,006.
Okay, so the 1,006 is the profit, is the actual profit now, which is the 80 times 20, isn't it? All right. So I'm saying that for you to come here, if you come here, what is the difference? What is the difference? It's 400 over here, isn't it? So instead of you subtracting the 2,000, don't subtract 2,000. Just come and add 400 to the 600 to make it what? 2,000, so that they will cancel off. So what we normally do is that we add unrealized profit to this one, 400. Then this will now be, this will be 18,000 against 16,400. The same thing, we have the profit of 1,006. All right. This is one way of dealing with the unrealized profits. But what did the standard say? The standard says that you cannot sell to yourself. You cannot sell to yourself. Since you cannot sell to yourself, it means that you have to remove the sales. So you cannot sell to yourself, you have to remove the sales. So what we normally do is that since the parent cannot sell to the subsidiary, we assume that there was no sales of 10,000 because you cannot sell to yourself. So there was no sales of what? 10,000. Are we okay there? Are we okay with
Yes.
the 10,000. Okay. So the cost of sales will still be what? 8,000. But can you permit me to change the cost of sales for the subsidiary? Let me change this figure. It will be 10,000. Let me do some changes to this one. 10,000 minus 2,000. Do you agree with that?
That's fine. So I can.
Do you agree with that? Do you agree that the cost of sales for the subsidiary is 10,000 minus 2,000? Do you agree with that? The cost of sales for the
Yeah,
subsidiary.
you said all were not sold.
Yes, so it is a 10,000 minus what? 2,000, which is same as what? 8,000.
8,000.
Okay. So the standard says that assume that there is no sales because you can't sell to yourself. So we subtract the selling price from the revenue because there can't be sales. So if you subtract 10,000 from 10,000, it means that 8,000 becomes the actual sales, which is for the subsidiary, isn't it? All right. So this will now be 8,000, which is become the actual sales that I said later. So let's come here. What are we going to do to this one? The subsidiary is going to receive these goods at what? 10,000, which is the 10,000 here. So we assume that they are including all the 10,000 as a cost of sales. So what we do is that let's come and subtract the 10,000, which is the revenue. So let's subtract 10,000. But how much was there? How much was there in relating to the goods for the subsidiary? How much was there?
8,000.
It was 8,000. So if you are subtracting 10,000, it means that you are doing what? You are subtracting more than. Isn't it? You are subtracting more. You are subtracting more. You are subtracting 2,000 more. You are subtracting 2,000 more. So if you are subtracting 2,000 more, what should have been the cost of sales for the goods sold? What should have been the cost of sales for the goods sold? What should have been the total cost of sales for the goods sold? The 80 sold. What should have been the total cost of sales?
That was 6,400.
But what is the cost for the parent? It's 8,000, isn't it? It's 8,000. Okay. So we should have subtracted 1,006 from this one. But how much did we subtract more from the cost of sales? It's 2,000. Is it 2,000? We subtracted.
Yes, and we came to add 400.
Yeah, we subtract 10,000. The cost of sales for the subsidiary should have been 8,000. But we assume that there is no sales, so we subtract all the revenue. So right now we subtract 10,000. It means that we subtracted what? 2,000 more. Isn't it? We subtract 2,000 more, isn't it? Are we here? Where is it?
It's like I am getting confused.
Okay, don't worry, I'll take it again.
Where we ended first, I was okay. After the 400, you said there shouldn't be any sales. So
Okay.
we should just deduct add the 400. That is the unrealized profit to the
Okay.
cost of sales.
Okay.
I'm okay with that.
Okay.
And now you said per this thing, we are not supposed to trade among ourselves. So whatever you've sold to me, you have to take it, and whatever I also sold to you, you also have to take it out.
Exactly. That's what they say. So
yeah.
So the total revenue will be 10,000 plus 8,000. That is what we have, isn't it?
Exactly.
Who is selling? It is the parent that is selling to the subsidiary. So the parent will sell at what? 10,000. But the standard says that you can't sell within yourself. So what we are going to do is that the parent is going to cancel the sale.
The 10,000
The 10,000. So
and the
that,
revenue.
yes, so that the actual sales will now be 8,000, which is for the subsidiary, which is now the actual sales for the group, isn't it?
Okay.
So if the parent is now going to cancel the sale, then the subsidiary will also include the
Do say.
10,000 as cost of sales. So
I
go and
get
take the
that.
10,000 also from the cost of sales. Are you okay?
I'm okay with that.
Okay. But in the cost of sales, the figure for the subsidiary was only 8,000, not 10,000. So if you are coming to subtract 10,000, it means that you are subtracting 2,000 in excess, isn't it?
Please, so come again. In the cost of sales,
For the
you said
subsidiary,
the figure for the subsidiary.
was only 8,000.
Why?
Because they sold 8,000, the cost is 8,000 for the subsidiary.
Okay.
Are you okay with that one?
Yeah.
The selling price, the goods sold by the subsidiary is the same as the cost because they are not making any profit on the sale.
Yeah, I'm okay with that.
Okay. But the standard service should subtract 10,000 all the revenue, assuming there is no sales. So if you are subtracting 10,000 as the one relating to the subsidiary, it means that you are subtracting 2,000 more, isn't it?
Mm-hmm.
Okay. But what should have been the actual cost of sales for the parents is 6,400, isn't it? The actual cost of sales for the 80 goods sold, 80 times 80, 6,400, isn't it?
Yeah.
Okay. So 6,400, it means that we should have come and subtract 1,006 from this place. We should have come and subtract 1,006 from this place, isn't it?
Yes.
Okay. But in this case, we didn't subtract 1,006 from here, but we subtracted 2,000. It means that we have subtracted 400 more. We should have only subtracted 1,006. That is the cost relating to the goods that were not sold. But we have subtracted 2,000. So what we do is that, okay, how do we make the 2,000 balance? Come and add 400. So that the 1,006 over here plus the 400 will cancel the 2,000 excess over here. That's what we do. So for this one, what the standard recommend is that when there is sale between the group, assume that there is no sales, subtract the sales from the revenue and cost of sales, come and add only unrealized profit. That is what I have done. That is what I have done. So what the standard recommend is that when there is a group sales, assume that there is no sales, go and take the sales from both the revenue and then the cost of sales. If you are taking the sales from both the revenue and cost of sales, you are going to subtract an amount in excess of what you should have subtracted from the cost of sales. For you to neutralize that, come and add the unrealized profit, which is the 400. So that is the treatment for statement of profit or loss account. So when there is a group sales, take the total selling price, which is the post-acquisition sales, It can happen that there is a trading relationship between the parent and the subsidiary before the parent acquire the subsidiary. That particular sales is not a group sale because it's just like the subsidiary was a third party to the parent before the parent acquired the subsidiary. So this one, we only look at the sales made to the subsidiary or the parents after there is a parent-subsidiary relationship. That is the only sales that we take care of. So when there is a sale, which is the 10,000, the standard says that you can't sell to yourself. So remove the sale. So you take the 10,000 from both the revenue and then the cost of sales. But the actual cost of sales that you should have taken away should have been 1,006. But you have taken 2,000 in excess. It means that there's a 400 like in there. So come and add the 400 to the cost of sales. Then you now have ni ama.
Sir,
Yeah.
so please, you were saying that that's what the standard says. They cannot have access to the standards, or you are going to provide a soft copy or something of that sort.
The standard is IFRS 10. You don't have the standard on that one, which is the standard is the group accounts.
Yes, I'm saying, are you going to provide any book or something of that sort? Like, are you going to provide any soft copy for the standard people? So that, yes, please.
Everything about the standard, everything about what the standard says is in the notes, which is the group account. The group account is prepared based on maybe about 5 standards. Business combination, which is the IFRS 3, consolidated financial statement, which is the IFRS 10. We also have the investment in associate, which is the IS 27. So you can see that at the beginning of this one, I put the standards there. So that notes, all the notes prepared over there is based on that standards. So if
It's already on the page.
the group accounts, yes, I put the group account on the page. Group accounts.
Oh, okay. And then I'm yet to see it.
Okay. Then go through group
Okay.
accounts. So that is what the standard says. So for us not to waste time, the standard says that there can't be any cells. So remove the cells, the post-acquisition cells. Take the actual cells, which is the 10,000, subtract it from both revenue and cost of sales. Come and add the unrealized profit to the cost of sales. You are good to go. That is all. The treatment is still the same. You go and subtract unrealized profit from the inventory. Okay. Whatever I've said earlier is still the same. But we just want to do what the standard says. There can't be any cells. You can't sell to yourself. So remove the cells. Are we okay? Can we go? Can we move on now? Kati.
Yes, sir.
So any of them that you are okay with, if the first one that I've done, if you're okay with that one, that you can go about it like that, you can only come and add the cost of sales to the unrealized profit to just the cost of sales and leave it like that. You don't have any problem. At the end of the day, you get the same gross profits. It's the same workings. Are you getting it?
Okay, please. This is the way I understand it. You deduct any transaction between the two of you, the parent and the subsidiary.
Exactly.
So you take the 10,000 from your revenue as the parent, and then you take the 10,000 from your cost of sales as the subsidiary.
Okay.
And now there's an unrealized profit of 400.
Okay.
That's unrealized profit. You have to go and take it out and add it to the cost of sales. The reason why we add it to the cost of sales is going to reduce the revenue.
Yes. Yes.
Am I right?
Yes.
Okay.
Okay. So if you have any question, just look for the selling price. Go and take it from both revenue and this one. Calculate for the unrealized profit. Add it to the cost of sales. That is the song that we normally sing. But I'm just telling you the idea behind that. All right.
Okay.
Are you okay?
Thank you. Yes, please.
Okay.
I'm okay.
Okay. Can we move on? Eva, are you okay? Eva, are you here? Eva, are you here?
Yes, I'm here.
You are okay?
Yeah, I'm following.
Okay. Are you sure? Your voice is down.
Yes, my voice is down because it was becoming plenty, but I think after watching the video again, I'll get it out.
Okay, don't worry. Just go the way you know it, isn't it?
Okay.
Subtract the selling price from both the revenue and cost of sales. Calculate unrealized profits, come and add it. That is all. Are you okay?
Okay.
All
Thank
right.
you.
Let's go to intra-group transfer. We have intra-group trading, which is what we have looked at. We also have intra-group transfer. Intra-group transfer, we are going to look at transfer of PPE. Transfer of PPE. So you have a delivery van at your headquarters in Accra here, which you are not using. So the people in Kumasi, the branch in Kumasi needs it. So what are you going to do? Are you going to buy a new PPE for them, a new delivery van for them, or you just send the one that you are not using here to them? Are you going to buy a new one, or you just send the one that you are not using?
You send.
You send the one that you are not using, isn't it?
Yes, please.
Okay. If the one that you are not using, the carrying value, is 10,000, and the remaining useful life is 10 years. It's 10 years. But at the day that you are transferring this, you have realized that the fair value of the machine was 15,000, and the useful life is still the 10 years. Which of these value are you going to transfer the PP, the delivery van, which of these value?
The fair value.
Why should it be a fair value?
Because it's a current.
Because that
It's
is
a
what
current value. It's a current value of the asset.
That the carrying value is 10,000, the fair value is 15,000. So which of these value?
Yes, it will be the difference.
Which of these value? You have the asset you are not using. Currently, if you are using it, the price will be 10,000. Are you getting it? If you are still using it, it will still be 10,000, isn't it? Now you are not using that, you want to transfer it to another branch. Which of these value are you going to transfer it?
The fair value.
Is it 10,000 or 15,000?
The 15,000.
Why should it be the 15,000?
The fair value is the amount like that is between the two of you. I mean, you come to
Agreeable amount between the two companies. Yeah.
knowledgeable, yes.
So if let me ask this question. If the branch is using the asset, is it not the same as the head office using the asset?
Yes.
Is it the same like the head office using the asset at the head office?
Okay, because they are not supposed to make profit, they have to transfer it at the same amount. So
Yeah,
the 10,000.
it's the same as you. Like it's the same like you are the one using the asset.
Oh, then the 10,000.
Yes, because the branch is not different from you. It's just like you are using the asset through the branch. That is it.
Okay, sir. So if they are selling it, if they are giving it out to someone that is not part of them, then that would be for
That is why they can sell and make profits.
Okay.
If it's like you are giving the asset to the branch, you are not using it, so the branch needs it, and the branch is part of you. So okay, since you are not using it, let's make use of the asset in Kumasi. So it's just like you are the one using the asset in Accra here. It's just like you are the one using the asset in Accra here because it's the same like you. It's just like you have this thing. You now bought a new motorbike and you have the old one that you want to give it to your brother. Your brother is like you, or if you're using the this one, it's not like your brother. It's not like you are the one using this thing to your brother.
Okay.
So
any business between the two of you, you should consider it as it is you. So everything should be fair.
Everything should be fair. You're not going to make any profit. So the head office will transfer the asset to that place at the carrying value because that is the value of the asset. It's just like you are the one using the asset. You are the one using the asset. That is all. But what normally happens is that the parent or the subsidiary normally transfer the asset at fair value. So they assume that they are going to make profit. So if they are transferring the asset at fair value, what will happen? They will make a profit of what?
5,000.
5,000, which is supposed not to be so, isn't it?
Yes, please.
So if it is the parent that is transferring the asset, if it is the parent that is transferring the asset to the subsidiary, the 5,000 will be in whose profit?
The parents.
So where can we find the parent's profit?
Group retain earnings.
So what we normally do is that we go and take this profit from group retain what? Earnings, because you're supposed not to transfer it. You have to make a zero profit. Are you okay there?
Yes.
Okay. But if you are doing statement of profit or loss, they will give you investment income. And the footnote will tell you that, okay, the profit on the transfer of the PPE is included in the investment income of the parent. So what are you going to do?
You take it out.
You subtract.
You subtract the 5,000 from the investment income, isn't it? Okay, we are good to go. What is the another implication of this 10,000 and 15,000? What is another implication? What is
another implication is that the assets will increase.
Yes.
It will kind of add up to the let's say if the total value of the asset was 10,000. Now you are having another asset which the fair value difference is 5,000. So the 5,000 come and add up to the 10,000.
And as a result, what will happen to the depreciation?
Ah, the depreciation. The
Yes,
depreciation.
The depreciation is going to increase. So in actual sense, the depreciation should have been how much?
Okay, 10% on over 10,000 over 10 years. Am I right?
Yes, that will be how
1,000.
much?
1,000.
Okay. That should have been the actual depreciation if the parent is using the asset, isn't it?
Yes.
What will be the depreciation if the subsidiary is now taking the asset as 15,000?
1,500.
1,500.
1,500.
So what is the meaning? What is the meaning of this?
Over.
So it means that the subsidiary is charging 500 depreciation more, isn't it?
Yes, please.
So what are we going to do? Where is he going to take the depreciation to? He's going to add it to cost of sales, isn't it?
Yes, please.
So what should have been the actual depreciation? What should have been the actual depreciation?
10,000.
The 1,000. So what are we going to do to cost of sales?
You add the 500.
No. Depreciation is added to cost of sales.
You add it.
Depreciation is added to cost of sales.
So
If
we
you're
go and
adding-
deduct it.
Yes, if you're adding the 500 against me, that you are making it 2,000.
Yeah.
The 1,005 is already added. Are you getting it? All right. So you go and add it. You go and subtract it, 500, to make the depreciation now 1,000. But if you're not preparing statement of profit or loss, where are you going to get? What will be the effect of the 500 on the profit of the subsidiary? What will be the effect?
It
Let
will
me
increase it.
Let me use figures. If the subsidiary profit is 4,000 and the depreciation that is subtracted is what? 1,005. What will be the profit? 2,500. isn't it?
2,500.
What should have been the actual depreciation?
1,000.
So what should have been the actual profit?
3,000.
3,000.
So what are you going to do with the 500 now?
You have to add it up.
You have to go and add it to the 2,500. So if you are not doing statement of profit or loss accounts, the excess depreciation has reduced the profit of the subsidiary or the parent, any of them that is transferring. So the excess depreciation has reduced the profit. So what you do is that go and add the excess depreciation to the profit of the one that is receiving the assets. Are we okay with that one?
Yes, please.
Can I move on to another one?
Please, I have a question.
Okay, ask.
Okay, so it means that now the business combinations, if the trading is between the, let's say, the parent and the subsidiary, that's one, there will not be any profit.
Yes, because
Is that so?
the subsidiary is just like the business yourself. You can't set your
Okay.
own self, so you can't make profit from yourself.
Oh, okay.
Okay, so
Thank you. That's all.
any transaction happening between parent and subsidiary, the parent and subsidiary are now seen as one. So there can't be any transaction that will yield profit. So if it is a subsidiary that is selling the thing, the amount that the subsidiary will sell it or transfer it to itself is the same amount that it will transfer or sell it to the parents. So there is nothing like profit. Are you okay there?
Okay, sir.
Yeah.
Thank you.
Okay. So what will happen if you come to statement of financial position? We are going to see the delivery van there, isn't it? We are going to see the delivery van there, isn't it?
Yes.
Okay. If it is the parent that is using the delivery van, after the first year, what will be the carrying value? What should have been the carrying value after the first year?
Please, for who?
10,000 minus 1,000.
And that will give us
9,000.
9,000. That should have been the actual carrying value, isn't it?
Yes, please.
But in the books of the subsidiary, what will be the cost? What will be the carrying value of the delivery van?
15,000 minus 1,005.
What? Okay, 15,000 minus 1,005, which is how much?
13,500.
What is happening?
Sir, please, are you talking to us?
Yes, I said, what is happening? 9,000 and 13,000, what is happening?
The 13,000 is more.
It's more, isn't it? By how much?
Yes. 4,500.
4,500, isn't it? All right. So let's look at statement of financial position. I will show you something right now. Okay. Statement of financial position. The statement of financial position Are you both writing notes? Okay. So what will happen is that we add the items line by line, isn't it? We add the items line by line, isn't it? We just add all the items for the parent and then the subsidiary. So how much will we be adding for if the delivery run for the subsidiary? It will be 15,000. Then we subtract what from it?
1,500.
We subtract 1,500 from it, isn't it? Because the delivery run has been transferred to the subsidiary at 15,000. So in the books of the subsidiary will be having 15,000 minus accumulated depreciation. Are we there?
Yes.
Okay. What should have been the actual value? Excuse me, let me pick this call. All right, my people, can we move on? Are we here?
Yes, sir.
Okay. So I'm saying that if you come to the statement of financial position, for the subsidiary, delivery run will now be 15,000 minus the depreciation, isn't it? Which will be what? 13,500. But what should have been the actual carrying value of the delivery van?
10,000.
It should have been what? It should have been what?
10,000.
It should have been
10,000.
10,000 or 9,000.
And the carrying amount.
Yes.
9,000.
It should have been 9,000, isn't
9,000.
it?
Yes.
So what is happening here? It means that this has increased by what? 4,500. So we just come and subtract 4,500 here. You should have subtract 5,000, but you have expensed 500 already, which is the depreciation relating to that part. Okay, but what we normally do is that we assume that you can't sell this to the subsidiary. So what is the profit on the sale?
5,000.
So we come and subtract the 5,000 from the delivery van, which is the PP. Normally it is in PP. We are subtracting this because the 5,000 is included in the what? 15,000, isn't it?
Yes, please.
So if you subtract this, we now have the value to be what? 10,000. Are we there? If you subtract the 5,000 from the 15,000, the value will now be what? 10,000, which should have been the actual value that you should have transferred the assets, isn't it? Are we here? Kati, do you get it?
Please come again.
Okay, we are saying that in the books of the subsidiary, they are going to have a delivery round of 15,000, isn't it?
Yes.
But the actual carrying value should have been what? 10,000.
Yes, please.
So what do we do to 15,000 to make it 10,000?
We deduct the profit.
We subtract the 5,000, which is the profit, isn't it?
Yes.
So if you subtract the
Yes,
15, if you subtract 5,000 from 15,000, you now have 10,000. What should have been the
Yes,
depreciation that you should subtract?
5,000.
It should have been 1,000, isn't it?
Yes,
Yes.
But
please.
you have subtracted how much?
1,005.
So what are you going to do?
Subtract 500.
You add
The
500 back.
500.
You add 500 back. Are we adding or we are subtracting?
We are adding.
We add 500 back. If you add the 500 back, what is happening? You can see that the effect between 5,500 is 4,500, isn't it?
Yes, please.
Okay, so for you to tackle this question, what you have to do is that look at the depreciation from the perspective of the one transferring. What is the actual carrying amount? So the asset should have been transferred at this carrying amount. So if the asset is transferred at this carrying amount, what should have been the depreciation? Then you calculate it and put the depreciation there. The one receiving the assets now, if they are transferring the asset at fair value, what should have been the depreciation? This is the depreciation. It means that the person has charged depreciation, which should have been the depreciation on the carrying value. So look at the difference. What is the effect of this difference? This will always reduce the profit. So go and add it to the profits. Go and add it to the profits. Then you ask yourself, what is the effect of this? What should have been the carrying value if the asset was transferred at the actual carrying value? What should have been the carrying value? It will be the carrying value at the beginning minus the depreciation charge. What is now the carrying value in the books? It is the fair value minus the depreciation charge for that one. What is the difference between the two carrying value? Then you come and subtract that difference from the PPE. That is what we normally do. So you can see that I've subtracted the 4,500 from the PPE. That is what we normally do. If the asset is being transferred at a profit, if the asset is being transferred at a profit, what if it is a loss? What if it is a loss?
Please, can you go back to the PPE, that side?
Okay. The delivery van side.
Yes, the
Okay.
PPE, yeah.
So this will now be 9,000. So we are saying that we shouldn't have sold this one. So since the subsidiary is going to have 15,000, we have to come and subtract the profit, which is the 15,000 from, which is the 5,000 from 15,000 to
Okay.
have what, 10,000, isn't it?
Yes, please.
So if it is 10,000, we should have subtracted the depreciation of what, 1,000. But we have subtracted 15,500. So we come and add the difference, which is 500
Okay.
to make it 9,000. That is it. All right. So the two transactions that we have looked at, they are all at profit. Let's assume when goods are being transferred at a loss. Let's look at the loss side. And we count to when the assets are being transferred at a loss too. Then we move on to another intra-group transactions. Can we move on? All right. So let's look at the parent. The parent. So 100 bags of cement.
Can you please increase the font size?
Yeah, that is
It's
what
too
I'm
small.
trying to do. Is it okay now?
Yes, please.
So 100 bags of cement at 80 cedis. At 80 cedis each. What will be the total selling price?
8,000.
8,000. Okay. 100 bags of cement. These bags were bought. These bags were bought at 100 cedis. What should have been the cost price?
10,000.
10,000. So there will be a loss of what?
2,000.
2,000. Okay. Are we there? So let's come to profit or loss. Statement of profit or loss. Profit or loss for the parent. The parent will be having a revenue of what? The parent will be
8,000.
having a revenue of what?
8,000.
Okay. Cost of sales of what?
10,000.
10,000. 10,000. So what will be the value of the goods transferred to the subsidiary?
8,000.
8,000. Okay. So let's come to the subsidiary. So if the subsidiary was able to sell only 6,000 of the 8,000 goods, what will be the revenue for the subsidiary? What will be the revenue for the subsidiary?
6,000.
6,000. What will be the cost of sales?
8,000.
6,000 or 8,000?
Hey, it said 6,000. So they sold only 6,000 out of
Okay.
it. So
Yes.
it will be 6,000.
6,000. Okay. Are you okay? So these people will be having a loss of 2,000, and these people will be having a profit and loss of 0, isn't it? Because the subsidiary, the person who is receiving the goods is not expected to make any profit on the sale. Can we move on? Let's come to the group accounts. Let's come to the group accounts. If you are not, you see, this is the only way that, this is the only place that you are going to get this, because after all this, then we start solving questions. Like we solve like 5 questions, so don't worry. Okay. So let's come here. So if you are preparing group, it means that you are now combining the two companies. So the revenue for parents is 8,000, isn't it? You add the revenue for the subsidiary, which is 6,000. What will be the total revenue?
14,000.
Okay. Let's count to cost of sales. Cost of sales. We are having how many for the parents?
10,000.
How much for the subsidiary?
6,000.
Okay. So what will happen? We are having cost of sales of what? 16,000. A loss of what? 2,000. Do you have any issue with unrealized profit?
No.
Do you have any issue with unrealized profit with this particular one?
There is no profit here.
Yes. So if there's no profits, if the goods are being sold at a loss, we don't have any adjustment to do. You can just leave the financial statement like that because they have done the right thing. Are you okay? You can't say because the loss is relating to, we don't have unrealized loss. No, we don't have unrealized loss. If it is a loss, write all the loss out. So don't say there's a loss of 2,000, so you spread the loss also among these ones. No, we don't do it like that. Are you okay? Okay. But if you want to do what the standard says, we are just going to do that. There is no cell between the group, isn't it? If there's no cell between the group, how much are we going to be subtracting? How much are we going to subtract from both the revenue and then the cost of sales?
8,000.
We subtract 8 or 10.
8,000.
8,000. So if you come to this one too, we subtract what?
8,000.
8,000. So if you subtract 8,000, this will now be 6,000. And this will now be 8,000. So we still have a loss of 2,000. So when the goods are being transferred at a loss, we don't do any calculation for unrealized provision for unrealized loss. No. We just come and subtract the sales. Assume that there is no sales between the group. That is all. Go ahead. Don't do anything again. Are we okay there?
Okay. Okay. Maybe our time they will give us this. I've not seen a question with unrealized loss.
That is why I'm teaching you.
It's good.
Okay. Last sitting, there is no people. Last sitting for console, there wasn't any time that they settle consideration by exchange of what? PP.
Land.
Are you getting it? So maybe for that is why me, I don't teach people for examination sake. No. Though you are going to write exam, but after the exam, what happens? So since as far as you are trying to write an exam, you also have to learn this for maybe in the future.
Yes.
Are you getting it? So if you should be for okay, Ni.
Sir, please, I want to verify something. So what's the idea behind subtracting the 8,000? What's the main idea behind it?
The idea is you can't sell within the group. There can't be a sell within the group. You can't sell to yourself. So the sales now is the 8,000. That is the actual sales made. You can't sell to your own branch. No. So we assume that there is no sales between the group.
Oh,
that's
okay.
why we have taken the 8,000. Are you okay now?
Yes, sir.
All right. All right. Okay. So that is for this one. The trading. Let's come to transfer of PPE at a loss. Okay, before I'll move on to the PPE at a loss. Yeah.
Sorry, would you solve last year's question?
Yeah, I will do that for you.
Okay.
I'll do that for you. Are you okay?
Yeah, I'm okay.
Okay. Don't worry. Maybe the last year's question can even be the first question that we are going to solve. So don't worry. You'll be fine. You'll be fine.
Okay. So please, so let me ask, anytime they transfer anything like the PPE or something, anything,
Yeah.
PPE, we should calculate for the depreciation.
On the actual figure, which is the carrying value. And then also the value, the value that they have transferred the assets at.
Okay.
Okay. So if there's a transfer of PP, just assume that it's the one transferring. Just assume that the person is continuing using the assets.
Okay.
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 The person is continuing using the assets. Okay. Let me say something about fair value. We say the carrying value is how much? It's 10,000, isn't it?
Yes, please.
And remaining useful life is what?
10 years.
10 years. Okay. 10. Fair value is what?
15.
15. And the useful life is what? 10. Oh?
Yes, please. Yes, please.
Okay. Okay. You see the adjustment that we did for depreciation and those things, eh?
Yes,
the assumption is that the one transferring the asset is measuring the asset under cost model.
Oh, okay.
Is measuring the asset under what? Cost model. Under cost model is cost minus accumulated depreciation less any impairment, isn't it?
Yes.
So if you are carrying the asset at cost model, it means that you should have transferred the asset to the subsidiary or whoever you are transferring the asset to, which is part of the group at carrying value. Are you getting it?
Yes, please.
But what happens when the parent or the subsidiary is carrying this asset or is measuring the asset under revaluation model?
Oh,
Are you okay?
Okay, so that's where the fair value comes in.
That is where the fair values comes in. So if you are measuring the asset under revaluation model, okay, Ni, your hand is up, or is the old one?
Say, some of your tests, so we've not done a revaluation model. We've not done cost model. So Said you get my story.
Okay. That is PPE. Don't worry. You'll do PPE next week. Don't worry. But if you talk about,
Okay.
you see, you know how to calculate normal depreciation, right?
Yes, sir.
Okay. So the normal, Atu, they say you should share the food that you are preparing. Atu, you say I should tell Atu to Kwamina to
with
share
a
the food.
with a big
he's preparing.
saucepan.
Kindly off his radio. It is distracting. You see?
It's too early for us to eat this food.
I don't even know he's preparing food. Some people, hey, people, your mind is on the food. Hey, and so many. All right. So, Ni, if you talk about cost model, the cost model is the normal depreciation that you do. Every year, you calculate the depreciation on cost. Are you there?
Okay, sir. Sir,
Yeah.
please, when are we doing the standards?
The standards will start next week. I we finish ratios today.
Okay. So I was thinking that this console that we are doing, like my brother was saying, it comes with the standards. So
It comes
if
with
we
10% of the standards. Console has nothing to do with the standards.
You said it doesn't have nothing to do with
the standards. 10%. You only see 10% issue on the standard. So if you have done a console here, we are going to do standards, then you just understand what I'm saying.
Okay,
Yes.
okay. I thought we would do some before.
No. The standard has something to do with the final account. That is why I put the final account there, that we are going to do standard before we start the final account.
Okay.
All right. But the cost model is the normal depreciation that we do at the SHS. Cost, then we calculate the depreciation, cost depreciation. But with the revaluation model, what we do is that at the end of every year, we find the fair value of the assets and we take the fair value. That is the revaluation model. That is the revaluation. So at the end of every year, assets will be measured at fair value. At the end of every year, the assets will be measured at fair value, which we are going to do under PPE, property, plant, and equipment. The note will be on the page, maybe next week, Wednesday, because I'm hoping that we are going to finish the ratios today. Then we just move on like that. The ratios, all of you can calculate the ratios. It's just the report. So as soon as I've spoken about reports, we are good to go. You calculate the ratios and send it to me. I'll look at them. All right. So let's just proceed with the cost model and revaluation model. Just if you haven't done a cost model, if you don't know about cost model and revaluation model, Ni, are you a graduate or SHS student?
I'm a graduate, sir.
But you have done PPE during degree level, is it?
Yes.
And they taught you PPE cost model.
Based on what you are saying there, if that's the SHS model, yeah, then that one that we've done it.
Okay, but you haven't done the revaluation.
Revaluation, no, sir.
Hey, some of the university. Which university did you complete?
It depends on the course you did, though. It depends on the course you did in school.
So, but you have done PPE, you have done IS16.
Yes, sir. Yeah, what we did was more of the cost model, as you were saying that depreciation.
Yes, you can't do IS16 without revaluation model. So still you can't defend that. It depends on the course that you are doing. Since the course has nothing with the accounting, you have to do the IS16. But some of the lecturers, they are lazy, so they won't give attention to that. So you know of the cost model. So if you are carrying the asset at the cost model, then the asset should have carry out cost less accumulated depreciation, or just the carrying value. Are we there?
Yes, sir.
But for the revaluation model, what we do is that at the end of every reporting period, we find the market value of the asset. How much should have the asset be sold at the market today? So we just transfer the asset at that value. So if the parent or the subsidiary is measuring the asset under revaluation model, it means that the value at which they will transfer the asset will be how much?
So please come again. I didn't get you very well.
If the parent or the subsidiary is measuring the asset, the delivery van at revaluation model, so what would be the appropriate value for the transfer?
Using a fair model.
Yes, it's using the revaluation model, where at the end of every reporting period, the asset will be measured at market value, which is the fair value.
That would be the 15,000.
That would be the 15,000, isn't it?
Yes.
So the parent will just record revaluation surplus of 5,000. There will not be any adjustment on this particular transfer because the asset will be transferred at 15,000. So there won't be any adjustment on this one. But for console, what we do is that we assume that the person transferring the asset is measuring or is carrying the asset under cost model. That is where we do calculation. We do adjustment for it, like the first one that we did. But if the question says that the parent or the subsidiary is using a revaluation model under PPE IAS 16 to measure its property, plant, and equipment, then the fair value becomes the carrying value of the assets. The one transferring will only recognize a revaluation surplus of 5,000. There will not be any adjustment to this particular transaction. Are we okay?
Okay.
Please, can you take that one again?
Is that Kati?
Yeah.
Kati, I'm saying that you see the one that we normally do calculation for transfer of PPE. The assumption is that the parent or the person transferring is carrying the asset under cost model. In this case, the asset should have been transferred at carrying value, not fair value. That is why we do the workings to remove the fair value gain or the fair value, the issue caused by the fair value. That is why we do the adjustment, like the one we did.
So please, if you are transferring the asset, do you have to depreciate it before you transfer?
No. We find a value at the beginning, at the time that you are transferring.
That's the 10,000.
Yes. So if that is not the 10,000, if the asset is being transferred on July 1, and they have given you the value of the asset at the beginning of the year, which is January 1, it means that the person has used the asset for 6 months before transferring it, isn't it?
So you calculate for depreciation.
You have to calculate depreciation for 6 months, subtract from the value at January 1 to get a value at July. But most cases,
Before
they give
you
you the value
transfer.
at transfer. Yeah. Mostly they give you the value at transfer, at the transfer date. They give you the value at the transfer date. Are you okay?
Yeah, I'm okay.
Okay. But if the person is using revaluation model, we don't do any adjustments because the fair value is the actual value that they should have transferred the assets. Are you okay now?
What do you mean by we don't make any adjustment?
We don't make any adjustment because that is the appropriate value for the transfer of the PPE. So if I'm carrying the asset at fair value, it means that at the date that I'm going to transfer the asset, I have to determine the fair value of the asset and transfer the asset at the fair value. So the 15,000 is the ideal value, is the ideal value for the transfer. So there's no adjustment. So the 1,005 depreciation is the actual depreciation.
Okay.
Okay, let's move on. Let's look at when the asset has been transferred at a loss. When the asset has been transferred at a loss. When the asset has been transferred at a loss. So in this case, let's assume that the carrying value is actually 10,000. No, it's actually 15,000. Are you okay? And useful life is 10 years. So fair value is now 10,000. And useful life is what? Useful life is 10 years. Okay. The carrying value is 15,000 at the date of what? Transfer. Fair value is 10,000. Which of these values do they supposed to transfer the assets?
15,000.
15 what?
Yeah, please come again.
The carrying value at the date of transfer is 15,000. Fair value at the date of transfer is 10,000.
10,000.
Carrying amount.
Which of these value are they going to transfer the assets?
The carrying amount.
10,000 or 15?
10,000.
The carrying amount is 15.
Why should it be 15? The 10,000 I'll count you. Why should it be 15, Kati?
That's the carrying amount.
But they are telling you that the assets you can't sell the assets at 15. If you sell the asset to the market right now, it's not 15,000, it's 10,000. The asset will be
okay.
transferred at 10,000. The person saying 10,000. Why should it be 10,000?
10,000 should be because you are reconsidering the revaluation model. First, the asset. Oh, first the asset was 15,000, but now we are sending it to a subsidiary, then reevaluate, then it has reduced in value. That's why it should be transferred at 10,000.
Okay, you have the idea. But either revaluation or cost model, the asset will be transferred at what? 10,000. The 5,000 will be seen as the asset has been impaired at the date of transfer.
Okay, sir,
Impayment.
please, can you ask your question again so that I'll get the understanding?
So I'm saying that at the date of transfer, the carrying value of the asset is 15,000. And also at the date of the transfer, the asset is being deemed to have a fair value of 10,000. And I'm asking which of these value are like is the asset supposed to be transferred? Which of these value?
2,000.
So I'm saying 10,000, not the carrying value. You are transferring the asset at 10,000 because at the date of the transfer, it is assumed that the one transferring the asset has carried an impairment test on the asset and realized that the asset has impaired by 5,000.
5,000.
So the 5,000 difference will be taken as impairment loss.
Please come again with the impairment. Is it different from depreciation?
Yes.
Yes, impairment
Yes.
is different from depreciation. You say you did what account? You did which university did you say you go again?
EW.
Ah, no wonder. Hey, who is that? Let me see the name.
Oh, why?
Kwamina, you attended UW,
Yes, please.
Kumasi campus.
Winneba campus.
Ah, okay. Oh, but Winneba campus, they should have taught you that because I went to Kumasi campus, but I was taught impairments. I was taught some of the standards.
Yeah, we were taught, but it's been long a while.
Which year did you complete?
2018.
Your time passed. Your time passed. Me,
Okay.
I completed 2020. Corona, we are the Corona graduates.
Oh, okay.
Yeah. So Philip, I'm not sure Philip is there. Okay, Philip completed 2021.
Okay.
Yeah.
Okay, you are there. I know that. Okay, so you can see that some of the things that they have taught you are relevant small, Philip, and some of
Yes,
them
sir.
are
Yeah.
bogus.
Yes, sir.
Some of them are total bogus. Bola. If they say
Yes.
bola, do you understand?
Yes, sir.
Why?
By impairment, Deborah taught us impairment.
Deborah taught you for the impairment that they will teach you. So,
Yes.
so if whether you are carrying the asset at at cost model or revaluation model, if at the date of transfer the fair value is less than the carrying value, transfer the asset at fair value and recognize the difference as impairment. Are you okay? But if you are transferring the asset at cost model and at the date of transfer, the carrying value is less than the fair value, transfer the asset at carrying value. Are you okay? Okay. So this one.
Okay.
Hello?
Yeah.
Please, I have a question.
Okay.
I just joined today. So so is it possible to have a carrying amount less than the fair value?
Yes.
I thought the carrying amount is the difference between accumulated depreciation and the impairment. Just to write it down to the fair value.
That is not a fair value. You are still getting the carrying value.
I mean, the carrying amount. There's no difference between the
carrying amount is the same as the carrying value.
Yeah, I understand that.
Okay.
So even after deducting accumulated depreciation and accumulated impairment losses, that we get a carrying amount.
Yes. Which is the same
Just
as
to
the
write
carrying
it down to the
value.
fair. Okay.
Okay. The fair value is not in the fair value is not determined from the perspective of the company, but the carrying value you are determining from the perspective of the company. Fair value is being determined from the market.
Okay.
So if you should go to the market today, what should have been the value that you and someone you agree on to dispose of that particular asset. That is the fair value.
Okay.
Or something arm's length transaction.
Okay.
Okay, if you should sell the asset to the market today, at what price will you sell it so that nobody is going to cheat anybody? Both parties will be okay with the price. That is a fair value.
Okay.
All right.
So assuming at the market the value is 1,000 cedis.
Okay.
And you are carrying your asset at 1,200 cedis.
Yes, it means that you are carrying
So
the
they're
asset
saying
higher
you should.
than.
Yes, which is higher.
Yeah.
So they are saying you should write down the value to the 1,000 cedis by deducting your accumulated depreciation and the payments.
Yes, the impairment is now 200.
Yeah, so it means the carrying amount cannot be more than the fair value.
At the date of yes, the carrying amount cannot be more than the fair value.
Yes.
If that happens, it means that you are overpricing your assets.
Yes.
Okay.
So always you have to write it down to the fair value.
To the fair value, if the fair value is lower.
By deducting the impairment, yes.
Yes. But if the fair value is higher, it means that you're not going to sell the asset today. So still carry at the value that you are carrying it.
Okay, okay.
All right. Are you okay
Thank
with
you.
that one?
Yeah.
Okay. So if there is a loss, there is no adjustment. There is no adjustment to depreciation because still the 10,000. So the person will be depreciating the 10,000, which is the same as the ideal value. Okay.
Okay.
We are done with transfer of PPE and intergroup trading. Let's look at intragroup loans. Intragroup loans. Intragroup loans. Intragroup loans. Intragroup loans. Last week we said that purchase of preference shares does not give what?
I said.
Yeah.
Please. So from where we came from to the intergroup loans, the fair value stuff. So when you pick the fair value, it means you are not going to depreciate it again.
No, because the subsidiary has depreciated the asset on 10 years already, which is supposed to be the actual value. So, okay, let me take that side for you. It means that at the end of the year, subsidiary will charge a depreciation of 10,000. Are you there?
Yeah, I'm listening.
Okay, you understand the 10,000, the 1,000, isn't it?
Yes.
It means that in the books of the parent, the parent will now write off the 15,000 to 10,000 before they will transfer. So
that's the impairment.
Yes, so we are going to have impairment of 5,000. So if the parents should have been using the asset will still be at 10,000. And they will charge depreciation for 10 years, which is the same as 1,000, which is the same as what the subsidiary is charging. So there's nothing like over, there's nothing like under. Are you okay?
Is it because they are using a fair value of 10,000?
Yes. So if you are transferring the asset at the value that the parent should transfer it, the depreciation will still be the same if the parent is the one using the asset.
So we don't do anything.
We don't do any adjustment. 10,000, 10,000. There is no adjustment.
Okay.
Are you okay?
Okay. Yes, please.
Okay. But the one that you normally see in the exam is where the fair value is higher and then they transfer the asset at fair value, which the asset should have been transferred at carrying value. That is the only one that you see in the exam.
Okay.
Are you okay?
Yeah.
Let's come to it. If you are not getting anything, is Ato still doing the cooking?
No, I'm here.
Okay. Let's look at intragroup loans. Last week we said that purchase of preference share doesn't give what? Purchase of preference share doesn't give what?
Please, we couldn't join.
Last week.
I think
join.
But the
it
video,
doesn't give
but
it
the
doesn't
recordings
give
are there.
right, they give right to the shareholders. Or
Purchase of preference share doesn't give what?
right to the shareholders. Oh.
Doesn't give ownership, isn't it?
Yes.
Yeah.
So when the parent is buying part of the preference shares of the
Please,
subsidiary,
can you repeat what you just said? You said transfer of what?
Kathy, it means that you are not listening to my recording. So why am I even recording in the first place?
Oh, no, you see, I wasn't on it, so I don't have that part of it.
Ayo, I will send you I will send the video again to the Telegram page. Don't worry. I'm saying that
Okay,
purchase of preference shares doesn't give ownership.
okay, yes, it's true.
It is only purchase of ordinary shares that will give ownership to the investor, which will be called parent or something. So you can have a question that they will say the parent has acquired 10% of the preference shares of the subsidiary for this amount. Are you okay? Don't add, that should not form part of the control. Purchase of preference shares or preference shares doesn't give control. Preference shareholders are not owners. But it can happen that at the date of acquisition, the parent will buy part of the preference shares of the subsidiary. Part of the preference shares of the subsidiary. So let's look at this. If the parent is buying, the parent, which is A, is buying 10% of the preference shares for 20,000. 20,000. And this doesn't give ownership. So how would the parent account for the 10% ownership? Is it going to be asset or liability?
Liability.
No, for the parent is the one buying.
Okay.
Again, it will be an asset or liability.
Assets.
Assets, okay.
When
So-
the parent is the one buying the preference shares.
Okay. So in the books of the subsidiary, 10%, is it going to be a liability or
A liability to the subsidiary.
which will be how much?
10% of it is 2,000.
Is 20,000. No, we are just saying that is a dividend. The dividend is the 10%. So the 10% of the preference shares for 20,000. So he's paying 20,000 for the 10% that he's buying. Are you okay? So for the parent, this will be a financial asset. And this will be financial liability to the subsidiary.
Subsidiary. Is it because it's a purchase of preference shares?
Yes, the parent is going to account for this in accordance with financial instruments.
What if it's ordinary shares?
Then the ordinary shares will give control. Then we add it to the cost, or then we add it to the consideration.
Okay.
We add it to the consideration. So the calculation of the consideration will only include the amount that we pay for the ordinary shares. Preference shares will not be part. So if the preference shares is part of consideration, go and subtract the amount that you paid for the preference shares because it doesn't give ownership. So it's supposed not to be part of the consideration.
Can you please take it again? I'm writing.
Okay. I'm saying that in the financial statement, you are going to see cost of investment for the parents. So if the question says that the cost of investment includes the purchase for the preference shares, it means that for you to get,
You have to take it out.
yes, you have to take it out to get the amount that you are paying for the ordinary shares. Are you okay?
Yes, please.
Okay. The preference shareholders, who are they to the subsidiary?
Creditors.
They are creditors, isn't it?
Yes.
And now the subsidiary is just like a branch to the company. Are you there? Can you give loan to your own company?
No.
Okay. But if you are buying part of the loans of your own company, what is the meaning? What is the implication of that? If you are buying part of the loans of your own company, it means that what?
You have an asset.
No, it means that you are paying off people who are the creditors to the company. Should I take that one again?
Okay. Okay, so the preference shareholders are the creditors.
Are the creditors. So if the parent is buying, it means that the parent is buying part of
the creditors.
The creditors. So the parents cannot have financial assets. You are just paying back them. So when you are doing this, at the day that you are doing this, the parent cannot have investment in its own company. So if you are consolidating, what you are going to do is that you have to go and remove the preference shares as a financial asset for the parent, because you can't have investment in your own company. You can't be having investment in your own company. You can't be buying part of the creditors of your own company. It means that you are paying them off. You are just paying them off. Are you okay? So at the date of the consolidation, what we do is that you go to the financial asset of the parents, you go and take the 20,000. You can't have this. You come to the financial liability of this one, so you take the 20,000. You can't be a creditor to your own company. Can you be a creditor to your own company? No. That is the assumption. Kati, can you be a creditor to your own company?
No, please.
Now, so we take this one off. We take this one off. But assuming they have paid a dividend of 10%, what will be the dividend that the parent will be receiving from the subsidiary? 10% on 20,000 is how much?
2,000.
2,000. This one, so the subsidiary will also be paying a dividend of what? 2,000. Can you be a creditor for your own company and be receiving a return and be receiving interest?
No.
No. So at the date when you are preparing consolidated financial statement, the dividend that you receive from the subsidiary will be written off in your retained earnings, because you are going to add this one to retain what? Earnings. So you go and subtract it. You're going to subtract the dividends received, because you can't be a creditor to your own company and be receiving interest. Are you okay? So you subtract that one off. But what is the effect of the 2,000 that the subsidiary pays on its profits? Is it reducing the profit or is increasing the profits after paying the 2,000? Is it
Reducing.
Reducing. So right now you are canceling it. What are you going to do?
So you add back to the profit.
You go and add back. You go and add back to the profit of the subsidiary. This is the same. If it is the subsidiary buying the preference shares in the parent, it's the same treatment. Are you okay?
Okay.
This is also the same for loan notes. This is also the same for loan notes. Loan note is also seen as a liability. So if the parent is buying part of the loan note, we assume the parent is paying the loan note holders. So the parent cannot be having an investment in the loan note. So cancel the investment at the date of consideration, at the date of consolidation.
Consolidation.
But what normally happens is that if this is a loan note, this will be paid as an interest, isn't it?
Yes.
So if the finance cost, which is the interest, if the finance cost for the subsidiary is 10,000, it means that the 2,000 is also part, isn't it? If it is a loan note, the subsidiary will pay.
Okay. Yeah. Okay. Okay.
So what should have been the actual finance cost before?
8,000.
8,000. So in the statement of profit or loss account, what are you going to do?
You take 8,000.
You subtract the 2,000 from the 10,000 to have the 8,000. So what will happen to the finance cost now? What will happen to the interest? Are you going to add it to the profit of the subsidiary, or you are going to subtract it?
You add.
You add. Okay, that is the adjustment. Apart from this,
So it's the same as the dividend paid.
Yes, it's the same as the dividend, but just that the dividend doesn't go to profit or loss. Dividend is paid in the statement of changes in equity. So dividend is not profit or loss item. That's
so
why
you take it to the retained earnings.
Yes, you take the dividend to retain earnings straightforward. Are you okay?
I'm not getting the understanding.
You see, the finance cost contains interest. So if you have loan, you are going to pay interest on the loan, isn't it? So the interest is already included in the finance cost. But if you are receiving dividend doesn't count to statement of profit or loss. So the dividend amount, which is 2,000, is not part of the 10,000 for the finance cost. So you can't go and subtract. Are you okay? It is the profit for the year that you are going to pay the dividend out of. So the dividends will be added to the retained earnings of the subsidiary, but not to be subtracted from the finance cost in the profit or loss accounts, because dividend doesn't go to profit or loss. Katia, do you get understanding now?
Yes, please. I am. I'm very grateful for the explanation. I was confused.
So right now you're not confused again.
No, please.
Is Freeman there with you?
No, Fema is not here with me. I think Fema is having a little challenge. So
Okay, that is why the understanding is coming for you like that. If Freeman should be there, you people will be chatting and the concentration.
but who told you the other time she was here with me?
Thank you for insulting me. Why?
I didn't insult you.
I heard everything. I'm here.
Repeat what I said. What did I say? Did I insult you?
You didn't say insult me.
No, I
Because
just
if I'm
is
there, you
Freeman
will be
there with you.
chatting.
Is Freeman
Okay.
there with you?
I
She
mean, I
said
don't
no.
understand anything you are teaching.
You said?
I said, me, I don't understand anything. So I'll
You.
watch video later.
You, because you are having some challenge. Kati said that you're having some challenge with your network. That is why. All right. But since Kati is okay, Kati will sort you out. All right. So for up to this place, I'm sure this is the only intra-group transaction that you can see. But we will look at some of them to which you have to use standards. Another one is another intra-group transaction is where. So I've talked about the loan notes and the preference shares already, isn't it? All right, we are okay with that one. You see, sometimes the parents can say they are like Atu. Have you heard about investment property before? IS40.
Yeah.
Okay, that one too they taught you, but not into details.
Oh, they taught into detail, but it's a long time.
Okay, so okay, that is very nice. Long time. Let's assume that your things are all long time. That is why you have forgotten the things.
Oh no.
I will enjoy the lectures again.
So there's 2017 Oma year.
The 20 what?
2017, no.
We also have someone who is 2017.
Me myself.
Hey. Don't worry, we'll be very fine.
So we've forgotten everything, no.
Okay, so if 2017 I've forgotten 2007. And what are you saying?
2000 what?
2007.
Say it again.
Even 2007.
2007, yes.
Even masters 2009.
So, well,
So,
no comment.
Jose, you see, you
So
have
no
a
comment.
long way to go.
no comment.
And that is why I'm taking my time to do my best.
Yes, we
So
appreciate.
we are old
we
men.
appreciate.
We take your time and do that.
Okay, so nobody should come and be telling me that time is going, we have this. So I'll take my time slowly. But
Yeah,
don't worry,
understanding it is better. So
don't worry, you'll
we
be fine.
appreciate it.
You'll be fine. I'm
Yeah.
just praying that we should be true with the ratio so that if you go to exam, there is no way you can, at least if you can't do all the workings, you can do something for the console, at least you can get 14 or 15 marks. Then the ratio 2, you can do the calculation and do the report very well. You can get 15. Then you go and look for your 20 marks. 50. That is all. But I'm looking forward that at least 90% of the class to pass the FR.
Amen.
90%. So if you want to be part of the 10%, I have no problem with that.
You should have a problem.
No, the thing is, you see, you can't. No. We have laws and we have exceptions to the law. So you can't have everybody in the class that will be 100%.
Yeah, we know, but you should be worried about it.
I'm worried.
Not too much worried, but you should have a problem.
I have a problem. That is why I'm saying that I don't have a problem with it. You know why? Because the person has already made a decision to be part of the 10. So I can't do anything to change it.
Nobody will do that.
Then you have to be learning every day.
Yeah.
Okay.
We're all trying our best.
That is it.
Yeah.
Let's move on. So let's come to what we call the investment property. Sometimes one of the entities can decide to let each idle property to the other one, and they will say they are carrying the thing that in accordance with IS 40 investment property. Can you lease a property to yourself?
No.
If you have a headquarters over here and you want to open branch in Kumasi, you have a house there, and you say you are going to lease the house to the branch, can you do that? The property that is for the property is for the headquarters Accra, and now you want to open branch in Kumasi. You are saying that the headquarters is going to lease the building to the branch. Can that be possible? Is the branch a different company on its own? Kati, is the branch a different company on its own?
No, please.
No, please. So what we normally do is that you just assume that is the parent that is occupying the building again, because the branch is not different from the building. So what we do is that the parent will be accounting for this using investment property. So let's assume that at the time that the parent is giving the building to the subsidiary, the value was 5,000. At the end of the year, it is now 7,000. So the parent is carrying the investment property at fair value. So the parent will be having how much? How much gain? The parent will be having 2,000 gain, isn't it?
Yes.
The parent will be having 2,000 gain, isn't it?
Yes.
At the date of the lease is 5,000. At the end is 7,000. The parent is carrying the investment property at fair value. So at the end of every reporting period, it will measure the investment at fair value and recognize any fair value gain or loss. Are we there?
Yes, please.
So at the reporting period, what will be the value? What will be the gain? 2,000, isn't it?
2,000, yes.
But you can only get this 2,000 gain when you are leasing the asset to a third party.
A third party.
But in this case, this is your own company. So this cannot be accounted as what? Investment property. It will still be as PPE. You are using it for administrative purpose. So what you are going to do is that where are we going to see the gain? For the parent, what are we going to see the gain?
Your return earning.
So what are we going to do? Subtract or add?
Subtract.
Subtract. In the PP, the parent will be having 7,000 as what? The value of
The
the
carrying
asset.
amount.
What are we going to do over here?
We deduct the 2,000.
Okay. Now the subsidiary will carry the asset as what? PP and depreciate it. So the subsidiary will carry the asset at 5,000 and depreciate it. That is cost model. But if it's a revaluation model, then the parent is okay to have the 7,000. Then the subsidiary will now carry the asset at 7,000 and depreciate it. So maybe you should check this one. 21 November console. There's a question on this particular one, investment property. When there's an investment property, okay, Ni?
So they are all these things that are all doing. They are in a what's the name? They are in a group account, the one that you submitted.
Yes,
the one that you
yes.
present.
This intra-group transactions. If it is not there, then I have to go and get them and add it.
Okay, sir.
But that is why I'm taking my time so that you can write notes. You can jot some notes down. I hope you're having some notes there.
Yes, sir.
Even if you're not having notes, you can still go and watch the video again and do the notes from the video. Are you okay there?
So it's just the principles, no. You know the standards, the principles you are using.
Okay.
It has to be on. It has to be in red line.
Okay. Okay. So this is all about the listing, the
investment property.
Yes, that is all about investment. But I'll try to pick a question that will have something to do with the investment property, so that we do the workings and you see. Are you okay? Okay. In the exam, what are the things that the examiner is looking for as far as consolidation is concerned? If you are preparing statement of profit or loss accounts, sometimes they can be asking you to prepare net asset table. Net asset table. What is the importance of the net asset table? You are just preparing the net asset table to know the value of the company that you are buying. What is the value of the company that you are buying? to know whether you are paying more for it or you are paying less. If you are paying more, it means that you are paying for something that is not there, which we call last Saturday or last week goodwill. Are you there?
Yes.
Okay. If you are paying less for it, we call it negative goodwill, which we call gain on bargain what? Purchase. It's a gain sent into the retained earnings of the parents. So for the net asset table, what we do is that we prepare it at the beginning and also at the end. At the beginning and also at the end. The beginning one, what we are doing is that for the beginning one, what we are doing is that we just want to know the value of the company that we are buying at the beginning. So the net asset represents what? The net asset represents what? The value for the ordinary shareholders, isn't it? The net asset represents the value for the ordinary shareholders. The value for the ordinary shareholders. So this is calculated as total assets minus what? Total what? Liabilities. Total asset minus what? Total liabilities. You know the accounting equation is what? Asset is equal to capital plus liabilities. So if you want to find ordinary shares, which is the equity, subtract your total liabilities from your total assets. Don't forget to add preference shares to your liabilities. Preference shares are liabilities. Add it to your
Is that
liabilities.
total assets minus what?
Total asset minus total liability. That is how we calculate the net assets. For this one is total assets minus total liabilities. And don't forget to add your preference shares to the total liability. So we are going to look at the net asset. Yeah.
The total liabilities, does it comprise of the current and the long term?
Yes, that is the total liabilities.
I think last week I saw some ratio question in the end.
That is for ratio for standards. For console,
okay.
For console, net asset is defined as total asset minus total liabilities.
Okay, sir.
But for ratio calculation, net asset is defined as total asset minus total current liabilities.
Oh, okay. Okay, sir. Thank you. Yeah.
So we do this one at reporting. The reporting, me always have been telling people that the reporting is not necessary. The reporting is not necessary. We do the reporting to know the actual profit made for the year. You can also take the profit of the subsidiary and make any adjustment that have to be made to the profits, which wasn't made. But since we are all familiar with the net asset table, I'll just use the net asset table to do this one for you. But I'll also use the one that you will use the net asset table. If you like, you pick the one that you like. Are we there? Can we move on? Okay, the first working that they will see is the group structure. I'm telling. The first working is the group structure. The first working is the group structure. It's very important. The group structure, what I'm saying is that what portion of the subsidiary is the parent holding? So if the parent is holding 70%, you put 70% here. It means that the parents cannot control how many percent?
30.
That 30 is for people that you call what?
Uncontrolled.
Non-controlling interest, which is non-controlling interest, which was first called what? Majority what? Minority interest. So we have 30%. So this is the group structure. Sometimes they will not give you like this. They will give you shares. So if the parent is buying 7,000 out of the 10,000 shares, what portion is the parent buying? How do we find the percentage?
7,000 over 10,000 times 100.
Okay, and a 3,000 over. How do you find a non-controlling interest?
3,000 over 10,000.
Okay, so that's how we do it. Are we okay? All right. So let's come to the net asset. The net asset, what we are interested in is in that we want to know the value of the
So
asset.
is that all, please, is that all there is to the group structure?
Yes, that is all the group structure. But some people, they are withdrawing something like a line, parents 70. No, you can put a group structure like this, parents 70%, NCI 30%. That's what you are good to do.
Okay.
All right. But the net asset, the reason why we are preparing the net asset is that we want to know the value of the company.
Please, Linus.
Yeah.
I think you have to get the reporting date too.
Is that?
The reporting date.
The reporting
date.
Date.
After the group structure.
Okay.
You have to know the reporting date.
Okay. That is also important. Okay. So after the group structure, what you have to show again is you have to show when is the reporting date. When are you preparing the consolidated financial statements? When was the subsidiary acquired? So you show date acquired. So if you are buying a subsidiary at 31 July, or let's assume it's 1st July, and you are reporting on 31 December. You are reporting on 31 December. You are reporting on 31 December. What is the post-acquisition period? From the time that you bought the subsidiary, for the time that you acquired the subsidiary to the date of reporting, how many months?
6 months.
6 months. So that is called post-acquisition what? Period. So post-acquisition period is what? 6 months. Post-acquisition period is 6 months. Post-acquisition period is what? 6 months. So you are going to consolidate the account for 6 months. Okay. But if you are buying the subsidiary at 1st January and the reporting date is 31 December, what is the post-acquisition period?
1 year, full year.
1 year, or you can make it 12 months. Okay. That is all. Let's come here. Okay, we are saying that we want to know the value of the subsidiary as at the day that we are buying it. But the standard says,
Boss, please, the post-acquisition, you said 12 months.
Yes, or 1 year.
So, okay, so the post-acquisition is always the accounting period. Is it always 1 year?
No, it can be 9 months, it can be 3 months. The post-acquisition period is from the day that you acquire the subsidiary to the date of reporting.
Okay.
So you can also buy the subsidiary at 30th September or 1st October, and the reporting period is 30th December. You can see it's only 3 months. So you consolidate the account for only 3 months. So that means the subsidiary was operating 9 months before you acquired the subsidiary. So you have no control over the 9 months. You can only have control over the 3 months.
So please, this one.
Kati.
Another one.
Okay. Freeman.
The date of acquisition is January. The date of acquisition is 1st January.
Okay.
And then to 31st December. So why is it 6 months?
No. It's 12. It's the first one that I wrote the 6 months. I didn't change that one.
Okay.
So the post-acquisition period is the day that they are acquired to the reporting date. That's the post-acquisition period.
All right. Thank you.
Right. So I'm saying that the net asset, the reason why we do the net asset is we want to know the value of the company or the subsidiary at the date of acquisition. And the standard, the IFRS 10 and the IFRS 3 business combination and consolidated financial statement. And IFRS 13 fair value measurement says that at the date of acquisition, the assets and liabilities of the subsidiary must be measured at fair value, must be measured to fair value, must be measured to fair value. So if after the date or at the date of acquisition, the question says that the carrying value of the subsidiaries plants is 10,000, but at the date of acquisition, this has a fair value of 15,000 now. This now has a fair value of 15,000 now. What are we going to do? They say all the value must be at the date of acquisition, all the assets and liabilities of the subsidiary must be measured to fair value. So what value are we taking?
Fair value, 15.
We are going to take what? 15,000, isn't it?
Yes, please.
But the 10,000 was already in the books of the subsidiary, isn't it?
Yes, please.
So what are we going to do to make it 15,000?
5,000.
We add 5,000 to it. So what we normally do is that I will just show you. I will just show you some sample. Who is doing the learning?
I'm the one. I'm now getting it that you said you have two formula. Either we use what we know and then, or what you are coming to add it. We can pick any of them.
Okay, so don't worry.
So your explanation is now making me to understand.
Okay, that's nice. Okay, so what we do is that the question will always give you the equity element. The equity element at the date of acquisition. So the first footnote will always give you the equity element at the date of acquisition. So the question can say that, okay, at the date of acquisition, the retained earnings of Kofi Limited is this amount. But they will not give you information about the share capital. The assumption is that the capital at the date that the company started is the same at the closing date. There is no additional issues of the share capital. So they will not give you information about the share capital, but go and take the share capital like that, because the assumption is there will not be any additional issue throughout the year. There's no additional issue throughout the year. So the balance at the beginning is the same as the balance at the end. So let's assume that we have the stated capital to be 20,000. And the question is saying that at the date of acquisition, retained earnings is 15,000. Okay, so at the date of acquisition, what is your net assets?
The 35.
35,000. So this is the net assets. If there's no, this will give you retained earnings. If there is no, the net asset is the equity part, is the ordinary share part. So how do you get the ordinary shares? Is the ordinary capital, or which is the stated capital plus their surplus. That is the ordinary share, which is the same as the equity, which is the same as the net assets. So if there's no fair value adjustment, it means that the date of acquisition, the value of the asset, the value of the company is what, 35,000, isn't it?
Yes, please.
If you are buying 70% of this, if you are buying 70% of this, and you are paying 28,000, how much should you have paid before? You are buying 70%.
24,500.
24,500. You are paying how much?
Yeah, you are paying 28.
What is happening?
You've paid more.
So the more is seem to be a goodwill.
Yeah.
You are paying for something that is not there. And this we are going to look at how to calculate goodwill. We have two ways of doing goodwill. So the one that I have done right now is what you call proportionate goodwill. All right. But we also have another one. We'll get to that place. Okay. But let's come here. What if the first thing that we have looked at, what if they say the value of the plant has increased to 15,000? What are we going to do? What will be the effect of that 15,000 on the net assets?
It will increase the net assets.
By how much?
5,000.
So we come here, we say fair value adjustments, which is only what? 5,000. We assume that the 10,000 is already in the net asset because it's already in the financial statement of the subsidiary. So it's included in the net asset. It's the one that is the increment that is not included. So we just come and add the fair value upwards, the upwards fair value adjustment, 5,000. Let's also assume that they say that building at the date of acquisition, building, the fair value of the building is now 2,000 below the current amount. What is the meaning?
You deduct 2,000.
What is the meaning? Below the fair value is 2,000 below the current value. I want to get a meaning first.
That's falling value.
So that means the carrying value is more than the fair value by what?
2,000.
2,000. So we need to write the value now to fair value. So the assumption is that the building has impaired by what? 2,000. So we count to fair value. Then we subtract what? The 2,000. So this is all done at the beginning. So the fair value adjustment, it depends on how they give it to you. It can be increased, it can be reduced. Are you okay? Are we okay?
Yes.
Okay. So let's come to the first one that I've given to you. It means that in the individual statement of the subsidiary, plants will be having a carrying amount of what? 12,000, isn't it? The first one that I've done at the date of acquisition, they say, okay, it's 10,000 rather. Plant will be having what? 10,000. That will be the value of the 10,000 in the books of the subsidiary because the subsidiary has not taken into consideration the fair value adjustment yet. So at the reporting, it will still be having 10,000 as the what? The value of the plants. But what should have been the value of the plants? What should have been the actual value? Kati, what should have been the actual value of the plants? Kati, are you there? Kati, are you there? Ibrahim, what should have been the actual value of the plants?
Oh, please, can you scroll up? I couldn't get down the figure.
Okay. So I'm saying that it was 10,000 carrying value. Now they are saying the fair value is 15,000. But the question says that the subsidiary has not yet incorporated the fair value adjustment in the books. It means that it will be having a plant of what, 10,000, isn't it?
Yes.
Okay. But this should have been how much?
15,000.
So what are we going to do?
So you just add 5,000.
Okay. If you add a 5,000, we add a 5,000 to this one. So if you add a 5,000 to this one, then you ask yourself, is plant a depreciable item?
Yes, please.
Okay. So if they say at the date of acquisition, the plant has a remaining useful life of what? 5 years. It means that the subsidiary was only depreciating 10,000, isn't it?
Yes.
But additional 5,000 right now will also come with what? Additional what?
Depreciation.
Depreciation. So you calculate the depreciation on the additional value, which is 5. That will give us how much?
1,000.
1,000. Since the subsidiary did not incorporate the fair value adjustment, the depreciation will also not be what? In the books. But since they are now recognizing the fair value adjustment in the books, it means that depreciation must also be recognized. So in actual sense, the value that we should have added to this one should have been 4,000, not 5,000. Are we there? Because the asset has been used for 1 year. Are
Okay.
you there? But since you are
Yes.
adding 5,000, it means that you come and subtract the depreciation of what?
1,000.
1,000. Where do depreciation go? Profit or loss, isn't it?
Yes.
Then you
Yes.
go and subtract the depreciation, or you go and add it to cost of sales if you are preparing statement of profit or loss.
Yes.
But if you are not
That's
doing profit or loss, depreciation should have been subtracted from profits, isn't it?
what we have wanted.
Yes.
So what we normally do is that we send it to the net asset table at reporting. At reporting, the profit is included in the
Maybe,
retained
yeah,
earnings.
maybe
All right. So that is the this thing. So if let's look at the second one, we say that the value has fallen by what, 2,000, isn't it?
Yes.
So let's assume that the initial value was 10,000 and the remaining useful life is 10 years. So now the actual value will now be 8,000 because it has fallen by what? 2,000. The remaining useful life will still be what? 10,000. But the subsidiary is yet to incorporate this fair value adjustment in its books. It means that the subsidiary is still having the plant at what price?
10,000.
10,000. So what are we going to do?
That's 8 times. That's 2,000.
With that 2,000. Okay.
Yes.
It means that the subsidiary is still depreciating the asset on what?
10,000.
10,000. So every year they are charging what? 1,000, isn't it?
Yes, please.
But the actual depreciation should have been on how much?
8,000.
So the actual depreciation should have been what?
800.
800. So what is happening?
So there's a.
This should have been 800. So they have overcharged their depreciation.
Extra charge of 200.
So what do we do? Cost of sales. Do we add or we subtract?
We subtract.
We subtract from cost of sales. But if you
Yes.
are not doing statement of profit or loss, this one that you have subtracted from profit has reduced the profit. So you go and add the 200 to the profit of the subsidiary. This is how we call the fair value adjustment. The fair value adjustment. Don't worry. You pick a question, you'll be okay. So what we normally do is that for net asset, what comes to the net asset is the equity elements. The net asset table is always having the equity elements. The net asset table is always having the equity elements. So the net asset table is always having the equity element. So you take the first equity element is share capital. Then you look for the value at the beginning. The value at the beginning. The value at the beginning, let's assume that is 20,000, isn't it? There is no issue during the year, so it will still be 20,000. Let's take retained earnings. Retained earnings will be, it is 15,000. And at reporting is 25,000. If at reporting is 25,000, it means that what? There's a difference of 10,000, isn't it?
Yes.
That 10,000 represents what?
Profit for the year.
Profit for the year. Profit for the year. Profit for the year. So I'm saying that instead of you to come and do this reporting, what you are going to do is that the profit for the year is 10,000. So what are the items that I'll use to adjust the profit for the year? I'll just use those items to adjust it, like this depreciation as a result of fair value adjustment. Okay, the 1,000 is going to be subtracted from the profit, so I will just subtract it. The 200, which was overcharged, will be added. I'll just add it. What are other items that I'll have? Do I have any issue about unrealized profit? Am I going to add or subtract? Then I'll do all this and have the actual profit for the year. Then I'll just share it among the subsidiary and the parent. You can see that you are doing the same thing that you'll be doing for the net asset table. So we have fair value adjustment. The first one is 5,000 for plants. So this one too, we are going to add it to this one. So this one still, we add it at reporting, because the fair value, since that is at acquisition, we assume that the 5,000 should also increase the net assets at reporting also. So that's what we do. All right. So we come to the next fair value, which is a reduction of what? 2,000, isn't it? This will also reduce this one at what? Reporting. Then let's count to the depreciation. The first depreciation is depreciation.
Where from the 2,000?
The 2,000 is a fall by. Is below, the fair value is below the current value by 2,000.
Okay.
All right. So the depreciation now on the first 5,000 is what? 1,000. But this depreciation will always be charged to what? Statement of profit or loss at reporting. So we send it to. In actual sense, it is going to reduce the profit. Where can we see the profit? It is at reporting. The profit is included in the reporting figure. That is why we send this adjustment to reporting. So this will be subtracted. Are we there?
Yeah.
Okay. The overcharge depreciation too. The excess depreciation. The excess depreciation, which is what? 200, isn't it?
Yes.
It was subtracted from this profit, so we have to come and add it.
Okay.
So this is what we do. That's why I'm saying that you can also take the profit and do this adjustment for them. This is how we calculate the net asset table. So the thing that you have to see under the net asset table is share capital at acquisition at reporting, return earnings at acquisition at reporting, fair value adjustment at acquisition at reporting, the same figure. Then you count to what are the sum of the adjustment that I have to make to the profit before I didn't do that. Because the profit is in the closing return earnings. Any adjustment that you have to do before you didn't do, have to be written against the profit in the return earnings. So you can see that the profit in the return earnings is what? Is 10,000. That is why sometimes you have post-acquisition. You do something like post-acquisition profits. Then the post-acquisition, this 1,000 will come, this one will come. It's the same as what I'm telling you to do. So you just take the profit out, then you net these ones them off. Because you see that yeah.
And say, let me go to the other one, the other formula you're adding to it.
Okay.
You said we should get the profits.
Okay.
Then we adjust it.
With any post-acquisition adjustment, that should have
okay, so can we come and add the fair values to it to get the add or subtract to get the profit? Can you go up a bit?
Okay.
So we were having 10,000 here.
Okay.
10,000, that would be the profit.
Yeah, for this one.
Mm-hmm.
So that would
then
be
what about the fair value? Do we come and add it to it?
The fair value will be 0 because we subtract this and this. 25,000 and 15,000.
You said the asset was there at 10,000, then it was fair value at 15,000.
At the date of acquisition again. All these things are happening at the date of acquisition.
Okay.
So sometimes you can also have a fair value gain, which is during post-acquisition period. That one will be added to the profit.
Okay.
All right. So you see the profit means the activity relating to the subsidiary after acquisition. This fair value adjustment is assumed that it was there before you acquired the subsidiary. So this one you can't have share of it because they were there before you acquired the subsidiary. But it is a profit that these are the profit that accrued after you acquired a subsidiary. So this is the performance. This is what was gained after you acquire. So it is only the profit that you can have a share of. But if it should be like, maybe the question says that at reporting date, the asset has now increased to 18,000 again. It means that you have
3,000.
3,000, which is for post-acquisition what?
Yes.
Period. So this will now be 8,000. So see, this one is as a result of you acquiring the subsidiary. So you can have a share of that one.
We add 3,000.
Yeah. So Kati, the assumption is that the fair value adjustment was there before you acquired the subsidiary. So you can't have any share of it because they have it before you acquired them.
The 8,000 came as a result of fair value the asset again.
Yes.
At the end.
Yes. So that one wasn't there before you acquired them. So you can say, okay, the time that I acquired you have you have this gain, so I can have a share of this gain now.
Okay.
Okay, but those activities that was there before you acquired them, that time you don't have control over them, so you can't have any share. But those activities that happens after you acquire them and their income, those are the only one that you can have a share of.
Okay.
So if we fair value the asset at acquisition,
Yes.
it was 10,000, then we fair value it to be 15,000.
Yes.
So we assume that at the end of the year, it would be 15,000, the same 15,000.
15,000, there was no gain again, unless the question say it has further increased.
Okay.
Are you okay?
Thank you.
All right. So this is how we do the net asset table. The next thing is goodwill. Goodwill, that's a goodwill. Let me talk about non-controlling interest because I'll end the class at 11 a.m.
Oh,
so we have just 3 minutes.
Yes, non-controlling interest. So sometimes, okay, you don't worry. I will talk about the non-controlling interest next week. Then we just solve a question. All right. So next week we are solving the question that the match question. That will be the first question.
Why won't you finish all the class? Why won't we give him some little time to finish the non-controlling interest so that you know we are done?
Okay, the non-controlling interest is the portion that you are not. So sometimes the question can give it to you in the exam. So they can give you the fair value of the non-controlling interest. But you have to know that any profit that you are going to make, any profit that a subsidiary is going to make will be shared between the parents and those people who are not part of the parent, which is a 70 against what? 30. So the non-controlling interest will take 30% of the profit, which will be 3,000. So this is at acquisition, then you increase it by post-acquisition profits, which is what, 3,000, isn't it? Which is 3,000. But we also have issues about goodwill, but I'll talk about that one if you look at the calculation of goodwill, which will be next week.
Okay.
All right. So do we have any question before we wrap up?
No, you allow you to go.
So,
Patty, are you okay?
Yes, please, I am.
Okay. Philip, are you okay?
Yes, please. I'll go
Sir,
for the video, please.
Sir,
yeah.
Please, can you go up a bit? I want to ask you something. If we do the net asset this way, are they not going to mark us like the ticks?
Yeah, even if you do the net asset, this one, they'll mark. Even if you do the one that I'm talking about, still is the same figure that you are going to use.
Are we going to get the same ticks?
Yeah, so they'll still, you have to calculate net asset before you calculate goodwill. So you are going to do net asset at acquisition and you get the same marks for them. Then if you are now adjusting the profit, you are going to use the same figures to adjust the profit. You still get the same marks. But me, I'm not saying that you should do the one that you are comfortable with. So
oh no, yes, but you see, time too is limited. So if
I'll use the two when we are solving the question. Then you pick the one that you like.
Because it's time. The timing is the problem.
Okay, I'll use the two. I'll use the two. Then you pick the one that you like.
Okay, thank you.
So we can now call it a morning, isn't it?
Yes.
Okay, thank you for coming. I'll see you in the evening.
Okay, thank you very much.
All right, you're welcome.